Okay, good morning, everyone. Call the meeting to order. And I'd like to ask all of us to just take a moment of silence to remember those that have passed since we last met, and our thoughts with the victims of the terrorist attack in France. Okay, thank you. All right, ask us to take a look at the minutes real quickly of the previous meeting. If you're so inclined, if there's a motion to adopt. Okay, it's been moved and seconded to approve and adopt the minutes as presented. Are there any comments, corrections? Seeing no one at a microphone. All those in favor, please signify by saying aye. Aye. Those opposed, no. And the minutes are approved. All right, Steve, we are ready to go.
At the October offsite, the board discussed the issue of disaster response. Specifically, left two members activated by a agency of the federal government, whether that's the reserves or the National Guard or another federal agency like FEMA or the National Disaster Medical Systems, to respond to natural disasters. And you had a number of questions about the process by which employees are activated for the Guard or the Reserves, and who decides when they're going to be activated, and who's going to get activated. Ryan's going to give you a brief update on the issue, especially for those of you who weren't at the last meeting. And then we will hear from Colonel Kevin McMahon. Colonel McMahon is the state's expert on those types of questions about the administrative process of activating employees and who decides that. And I'm very pleased that he was willing and able to join you today. He has assisted us, the staff, throughout the entire interim and even at the end of last session when questions came up. So he has been invaluable to the board, to us, even before today. This is just your first chance to sort of talk to him directly. With that, I'll turn it over to Ryan.
Thanks, Steve. For the record, Ryan Frost, board staff. As Steve mentioned, this is disaster response coverage. So the issue here is that Left Plan 2 members who are called up to federal service to respond to natural disasters receive only reduced non-duty death and disability benefits from Left Plan 2 if they are killed or disabled in the course of that service. So a number of Left Plan 2 members were recently called into federal service to respond to the March 2014 Oso mudslide, as well as the Eastern Washington wildfires in the summers of 2014 and 2015. Some members were sent by the employers, but many were also called into federal service by the National Guard, military reserves, and the National Disaster Medical System. So when members are called into federal service, they're classified as on leave from their employer. Therefore, they're granted no in-service benefits. And their benefits are treated the same as if they left their employment for any other reason. So there's been previous joint legislation that has provided some pension benefit protections for members called into federal service. The first piece was a 2005 bill, which allowed members and their survivors the ability to purchase up to 5 years of service credit if the member was catastrophically disabled or killed while in that service in the while in the uniformed services. That bill did have a couple caveats, though. One, it had to be during a declared national emergency or during a period of war. The second bill was a 2009 House Bill 1551 provided an unreduced survivor annuity to survivors of members of all plans who leave public employment to enter the uniformed services and die while performing that service during a period of war. Neither of these bills had an effect on contribution rates, but as we've talked about, there was a coverage gap. The period of war language created a coverage gap for responders to national disasters because national disasters are obviously not considered a period of war or usually declared as a national emergency. Therefore, neither the 2005 or 2009 bills provide pension benefit coverage for these federal responders. Additional legislation would be required to allow these members to purchase the unreduced survivor annuity and the option to purchase up to 5 years of service credit. So this is just kind of a little chart that I put together that shows a bit of the gap between members assigned by employers while they're responding to natural disasters and members called up into federal service. The X being the benefits they're granted. So that brings us with a couple options. One would be to direct staff to present a final proposal, which would provide the unreduced survivor annuity and the ability to purchase up to 5 years of service credit to members who are called up to federal service to respond to natural disasters and are disabled or killed during that service. And the second option today would be to take no further action. And with that, I would be happy to answer any questions.
At your September meeting, the board voted to move this to the final proposal stage for your December meeting. So this follow-up is mainly your chance to ask questions either of Ryan or Colonel McMahon. So if you have questions for Ryan, now would be the best time, but we can always bring him up after hearing from Colonel McMahon if you'd like.
Thank you,
Go
Mr.
ahead, Jeff.
Chair. Right, I'm correct in hearing that there's no fiscal impact?
There's no effect on contribution rates. There is some fiscal impact because you're granting a benefit that wasn't there before.
De minimis?
Yeah.
Thank you.
I don't know if I'd say de minimis. It's just not high enough to impact rates. How's that?
Well, or I don't know. Now, you could let the, if I say anything wrong, OSA can correct me. But part of the challenge on this one is it's indeterminate. The past fiscal notes were indeterminate because it was hard to come up with accurate assumptions about how many employees would be affected by being killed or disabled during time of war. There wasn't sufficient data to make accurate assumptions. Similarly, working with OSA right now, it has been very challenging coming up with accurate assumptions on how often do these events occur, how many LEOFF employees are going to get activated, what are their rates of disablement or death during the course of that service. So I don't want to get out in front of them, but if the fiscal note is similar to the fiscal notes in the past, it would be that there is a cost, but it's indeterminate, in which case no rate change would be recommended by OSA, but whatever the cost would be based on experience, actual experience.
Follow up on that. In consideration of the fact that something like this is not enough of a cost to raise enough of a flag for somebody to do an analysis on this and say, well, there's a potential impact, or even surmise at this point. From a moral point of view, I think the whole concept of putting something like this in place in the first place was when you actually have a call-up for federal service that we would cover the employee. It wasn't when you say for war, there's an expectation or an assumption that goes with that maybe that was unfounded. And this appears to actually kind of follow along the intent of the original idea of putting something like this in place, so that we, if there's not an issue that we have to discuss or debate a cost benefit on this at this point here, it almost seems like this is an easy follow. I'd be in support.
Okay.
this. If you have no further questions for staff, then we could hear from Colonel McMahon.
Okay. Thanks, Ryan.
Thank you.
Well, good morning, everyone. As noted, my name is Colonel Kevin McMahon. I'm the Director of Manpower and Personnel for the Washington National Guard on the federal side, and that's a fancy term for I'm the Human Resources Officer. On the military side, and to kind of describe that, you're all familiar on the Reserve and National Guard, the 2 weeks in the summer, 1 weekend a month. This is the job that I do both on weekends and full-time. I'm in what's called a Title 32 AGR Officer or Active Guard Reserve. So hopefully I can answer your questions today to help you make further decisions. This is the agenda that I'm going to use this morning. One of the things I want to do is quickly go over the National Guard itself. Some people make some assumptions when you compare Reserve and National Guard that they are one and the same, which is in reality not the case. And then we'll go through, talk about those differences, the various statuses that we use, and then also talk about the entitlements that each of those statuses equates to the individual. So to give you an idea, here within Washington, you have just a little over 6,000 Army National Guard service members and a little over 2,000 Air National Guard service members for a total of 8,100 Washingtonians that serve in your National Guard. These are the locations throughout the state where they serve. And while that may be where their unit is located within the state, that does not necessarily mean that they live within that specific community. For example, I was the commander for the battalion out of Spokane. I live in the greater Seattle area, and so on the weekend drills, would drive back and forth to that location. So we have a number of individuals that have to do that. For the National Guard, we basically serve under, or can serve under, two titles. The first one, which is more in line with what we do on a day-to-day basis, is under a Title 32 U.S. Code, which means we serve at the pleasure of the governor of the state of Washington. In the event that there is a call-up for state active duty, the governor is the one that declares that and then pushes that down to the adjutant general. Those forces then are notified and mobilized and then go forth and respond to whatever disaster or request we've been asked to respond to. On the Title 10 side, the Commander-in-Chief is the President of the United States. You see there the normal chain of command. And the typical times that National Guard service members are called to Title 10 is for wartime. For example, the deployments to Afghanistan and Iraq are typical of Title 10 deployments. At the bottom of the slide, note, though, that a National Guard service member cannot serve in both a Title 32 and a Title 10 status at the same time. It has to be one or the other. Any questions on that?
Thank you, Mr. Chair. Is there anything that says that a member or National Guard member will be recalled, whether they're in state service versus federal service? So, for example, if over the summer with wildfires, could they be called up to federal service, taken off the line, called up to federal service?
The short answer is yes, sir. If, for example, the President of the United States determined that there was a national security interest that required the mobilization of the Washington National Guard, and those forces were downrange fighting fires in a state active duty status, as long as the President initiated that recall or that request, those individuals would be pulled from the fire line and would move forth and do what is requested of them. I would assume, though, that the governor would work with the President and the Secretary of Defense to ensure that there's a proper handoff there so that they're not immediately yanked out and leave Washington kind of in a lurch.
Thank you.
Yeah. Any additional questions? So this slide, if I can take just a few moments, because at the end of the day for our service members, it really comes down to status. What status is that individual in? And so moving from left to right, you see we have a state status, which we refer to as the state active duty. And that is when the governor calls up the National Guard and asks us to go do things like the recent wildland fires in central Washington. Those individuals then are mobilized under a state status and technically become a temporary employee of the state of Washington. We'll get into the benefits that they receive, but they fall under the command and control of the Adjutant General and report directly up to the governor. There are times, however, when we are called into a Title 32 status, and those are examples like Hurricane Katrina and after 9/11. Those National Guard members then are paid for using federal funds, but still fall under the command and control of the governor and the adjutant general. So if I go back to the state active duty status, those are state funds used to pay those individuals. The Title 32 federal funds used to pay those service members, but again, work for the governor. And then if they're called to Title 10, those are federal funds falling under the federal chain of command, meaning the President, the Secretary of Defense, and the combatant commanders. And again, examples of that are Iraq and Afghanistan. So 3 different statuses that National Guard members can fall under. Questions there?
Go ahead, Jim.
Thank you, Mr. Chair. Just to clarify, sir, first, thank you for your service. I appreciate it. Is there a declaration made under the state active duty state status versus a Title 32 status?
So, yes, sir. The way this works, for state active duty, the governor will declare an emergency, will notify the TAG. That declaration typically comes up from the local emergency operation centers at the county level, and then the governor will go ahead and mobilize those forces. Under Title 32, it requires the Secretary of Defense approval for us to be mobilized in a Title 32 fashion. And I have a future slide that kind of talks to that. Because they are using federal funds, the governor cannot just call up the National Guard in a Title 32 status and expend federal funds on the behalf of the state without SecDef's approval. Does that answer your question, sir?
Yes, thank you, sir.
Additional questions? This is the reserve component. You can see there's different levels as to where the Secretary of Defense, the President, or the military department secretaries can call out the reserves. And again, to delineate, a National Guardsman works for the governor, typically resides within your state. A reservist is Title 10, works for the SecDef and or the President via that chain of command. Will also live in this state, but are 2 different military components if you look at them. On the military side, we refer to them as Compo 1, which is your active duty, Compo 2, which is your National Guard, and Compo 3, which are the reserves. As you go up the pyramid there, you can see, well, if I start from the top, working my way down, a full mobilization where the President can call up all of the reserves for whatever means that he or she determine that they need to be called out for. And then it goes all the way down to where the military departments can call them out for active duty operational support. Questions on this slide? Very good. Hopefully this slide will help a little bit as well. So on the National Guard side, can serve both in a federal or state status. One of the unique things of your National Guard is posse comitatus is not a restriction. We are there to support local law enforcement. We will not do local law enforcement itself, but we will support a sheriff department or whatever is requested of us, whereas the Army Reserves cannot because they are in a Title 10 status and therefore they cannot break posse comitatus and work at the discretion of your sheriff departments, for example. We are the most experienced within DoD response for natural disasters. We spend a tremendous amount of time training on that, and we also deploy, as we did this past summer in response to the wildland fires. While the active component and the reserves train on it, they are, in the National Guard's opinion, not the experts because they're not called out as frequently as we are. As you go down, looking at the Army Reserves for status, again, a federal status may provide support to the states if requested by the governor, but requires the SecDef to weigh in on that and approve it. Command relationship, we've talked a little bit about that previously, work for the governor on the National Guard side of the house. Army Reserves for the President. Any questions on this slide?
I had one question, Colonel. When I'm looking at this here, how long, when you talk about getting approvals, how quickly or slowly do these things occur? I mean, are they within 24 hours, 48 hours?
Sir, can you clarify, like state active duty or for the call out on a title?
Either one. I know that, as you've indicated here, you got to have approval by the SecDef here. I mean, how quickly do those things occur? I guess at the federal level is probably primarily where I think the perception is it might take a while.
Yes, sir. So to date, Washington has not, at least within my experience, been called into a Title 32 status, which requires a SecDef's approval in support of the governor. We did an exercise this past summer where we rehearsed that. Obviously, lawyers get involved. It goes up. We now have a standard packet that's been put together in the event. One of the things that we're training for is the Cascadia subduction zone. We made a number of assumptions that the minute the shaking stopped, that the National Guard would respond in a Title 32 status, meaning the feds are paying for it, but we work for the governor. When Northcom came in, they basically validated that that was a poor assumption. And so when we work through that, what we're trying to determine is at what point do we send that notification to the SecDef for his or her approval. We just don't know what that looks like. Some people say it will be quick. Others say it takes a period of time because they need to make a determination of, does the state really want that support, or is this just kind of a knee-jerk reaction? If it's the Cascadia subduction zone, I would think that the response would be fairly quickly. But again, sir, we just don't know at this time.
By way of example, and Ryan, correct me if I'm wrong, but maybe this will help too. For instance, OSO was, I believe, like on March 22nd. The governor declared a state of emergency that same day. The federal declaration of emergency with respect to OSO didn't happen until like April 11th. And similarly, during the last year's wildfire, the biggest one was the Carlton Complex fire. The governor had a declaration of emergency that same day. However, the federal declaration followed by a period of a couple of weeks. So in that sense, I don't know if that's the, obviously, as the colonel was saying, if you had like a major disaster on the scope of the Cascade subduction zone, that might be the time frame between the two would probably be much closer. But at least historically, there's a couple of examples for you.
So, Colonel, you mentioned on one of the earlier slides that I think Hurricane Katrina was one of those, and then 9/11 was the other one. Do we have, by example, how quickly or what the time frame was on those types of emergencies, so that we?
So yes, sir. So for Hurricane Katrina, Washington actually sent forces from this state down to Louisiana to support the response. What we had to do was work. Louisiana first initiated, hey, we need some additional support. The Secretary of Defense notified the various states saying, if you have resources, please let me know what those are so that we can mobilize them. And then we turned around as a state and said, we have X number of individuals that are ready to go. We then received a declaration placing those individuals into a Title 32 status and sent them down to respond. I'm going off of memory here, but we responded within about 72 hours from the time we received notification for the request and by the time the individuals were leaving for Louisiana.
Okay. Thank you. I appreciate that.
So this is the operational Title 32 code that you see there in 2006. Congress amended it. And this is where, in the event that the Cascadia subduction zone requires National Guard forces to respond in a federal status, they would be in this U.S. code, Title 32 502F. The benefit for our state would be, or for any state for that matter, is the federal government is using federal funds to pay for those resources, but they still work at the discretion of the governor so that they can respond to whatever he or she determines is the priority for their state. Now, this is probably where you're more interested in. These are the duty status entitlements. And so when we mobilize an individual onto state active duty, that first column are the entitlements that our service members will receive. If they're in a Title 32 status, meaning Cascadia subduction zone happens, SecDef approved, we've now transitioned all of our National Guard resources into a Title 32. The middle column are the benefits that they will receive. And if the individual is called a Title 10, so for example, being deployed to Afghanistan, The far right column are the benefits that the service member will receive.
Colonel, is there any integration of benefits with these issues so that one of our objectives has always been that our members that serve in this capacity will not be harmed, so to speak, financially as a result of their contributions here. So are there integration of benefits to where somebody doesn't, all of a sudden they're at 150% of pay versus 100% of pay? Or as they move through this, I mean, I guess the question is, could they be below or above their standard rate of pay on a call-up like this, whether it's, I guess primarily here we're talking about Title 32, I would guess.
Yes, sir.
And Title 10, but I understand that's much greater.
Yes, sir. The short answer is yes, sir. An individual could be making $100,000 and be an E5 in the National Guard, get called up on a Title 32 status, does not make $100,000 as an E5. So there are some disparities there. If I click down to the next one, let's say, for example, that E5 was killed. And as long as they were in a Title 32 status, they will receive a death gratuity of $100,000. Every single airman and soldier within the state is initially enrolled into our service member group life insurance, which has a coverage of $400,000. The individual has to basically waive that they want that amount. So they could say, you know what, I only want $100,000 instead of $400,000. Therefore, they have to sign some paperwork noting that. But every individual initially is covered under $400,000. The premium for that is paid out of their drill check. The death gratuity is just part of the service member's basic coverage. And so those are the benefits that they would receive if they were in a Title 32 or Title 10 status. Now you'll note under the death gratuity it says Title 32 non-drilling is $0. So if the service member is not drilling on the drill weekend or at their annual training event and is in an automobile accident and passes away, Title 32 will not provide the immediate death gratuity for them. They will still receive the $400,000 SGLI, but the death gratuity is not provided because they were not in an active status. One of the other things that we determined during the recent wildland fires of 2015 was for state active duty. Initially, there was an assumption that individuals at the lower ranks, so if I go back to their pay, you'll see that they receive $174 as the minimum. If you're a E7 with, let's say, 20 years of service, your daily rate is calculated at a higher rate. The concern was that if an individual was injured or killed, that they would not, that's a fairly low daily rate that would equate to what they would receive for a death gratuity. What we've determined since then is that's not the case. So the Washington Military Department is a little unique in the sense that if you're injured while on state active duty, it does not become an L&I claim. It becomes an issue for the Washington Military Department. We use the L&I calculations, but it does not get sent to L&I. If the individual was killed, then the Washington Military Department will calculate that using the L&I calculations, and then that will come out of our budget on an annual basis. Basically the same distribution L&I, but out of a different budget.
Okay, thank you.
And then the last one, more about the long-term benefits. Again, it really comes down to what status is the service member in, and then we have to take a variety of aspects into consideration. What did they make in the civilian world? What did they make as a drilling member? Take all those calculations together, and then we generate what the benefit to the spouse would be on behalf of that service member. Any additional questions? I'm not sure if that is.
Thank you, Mr. Chair. Sir, in your time in your position, can you give us maybe a general indication of what is the most common throughout the state during emergency is the Title 32 something that's more common, or maybe the state activation, which seems like it may be to address smaller issues, may be used more from a layman's standpoint? Can I get your professional opinion on that?
Yes, sir. So state active duty is by far the most common use of the National Guard within the state's borders. Again, on the drilling weekends, the 1 week in a month or the 2 weeks in the summer, those individuals will go into a Title 32 status and then are covered under those federal statutes and those gratuities or benefits that they would receive. But since I've been the J1, we have called out 3 different times in response to disasters. The Oso mudslide, the wildland fires last year, and again the wildland fires this year. Prior to me becoming the J1, I was the training officer for the 81st Armor Brigade, and during that time, the brigade was called out twice for state active duty events. So it becomes almost a yearly event where we call up upwards of 500 to 1,000 airmen and soldiers to respond to some type of event here within the state.
Colonel, what types of duties do those 500 to 1,000 people perform? Is it mainly like frontline firefighting type duties, or do they also perform logistical or administrative type duties?
All of the above. So, for example, 2015, we trained over 1,000 soldiers to be Red Card certified so that they could go physically to the front lines and put out fires. Because of that, that train up and where those individuals were at, there comes a logistical tail with that, meaning we had to provide fuel for our helicopters. We had to ensure that individuals were tracked properly so that we could make sure that they were paid. So all the administrative and logistic requirements to support those individuals come with that.
And are there any data or tracking in terms of the types of employees that you call up, whether or not they belong to state pension plans or what kind of pension plan they belong to?
Yeah, sir, the way we look at that is we call up units. We will take a look at what the governor's requesting us to do. So, for example, if I go back to the firefighting, we were asked to be able to prepare and provide upwards of 500 trained individuals that were Red Card certified. We looked across the units and determined that our cavalry squadron was best suited to do that type of work. We therefore then spent time training those individuals, and then when the call was made, that unit was the one that was activated to go forth and fight the fires. It just really depends on what the mission is. We're now heading into flood season, so at that point it becomes what resources are available to support that. Our engineer units are probably the better trained to provide the equipment to move dirt, fill sandbags, etc. So it just really depends on what the mission is.
Hey, Mark?
I have a question. So in the event that those folks get called up, somebody is actually performing what you consider, I guess, a frontline emergency function, and somebody else of the same unit is doing a logistical function. They both are injured doing those separate functions. Is there a difference in the level of benefits provided?
No, sir.
Okay.
Representative?
Thank you, Mr. Chair. Maybe this is a question for you, Colonel. Maybe it's a question for staff. Just listening to this so far, it appears that the National Guard and the benefits that they provide under Title 10 and 32 are fairly well defined. But it seems like there's 4, maybe 5 different potential scenarios. The benefits could be provided that would be differing benefits out there. You'd have National Guard under Title 10 state call-up, National Guard under Title 10 federal call-up, under Title 30, National Guard under Title 32 federal follow-up, reservists under Title 32 federal call-up, and if it somehow works that way, can reservists also be called up under Title 10? And if you have these 5 different scenarios out there, is there a differing level of benefits that would address those benefits that would be lost as an employee for our system, fire and cops out there? And would we have to have staff break down the loss or the difference in benefits between each of these scenarios and attempt to accomplish coverage of that before we move something like this forward.
That same complexity arose with respect to the military benefits, because you could get called up under 10 or 32 into either the guards or the reserves. The decision there was made not to try to create an equivalency in the sense of figure out whatever dollars you would have gotten under state benefits and then do an offset to make sure that your combined benefits don't exceed that threshold. The decision under the prior legislation was simply that we know some members might get more and some members might get less, but we would solely with respect to their pension benefits, treat those as no early retirement reductions, so that you won't gain on your pension, but you won't lose on your pension in terms of what you've earned up to that point in time. Anything else in terms of lump sum death benefits, life insurance benefits, medical benefits, workers' compensation benefits was not considered, and with the understanding that depending on the circumstances, for instance, the lump sum death benefit of $100,000, that's less than the lump sum death benefit in LEOFF 2. That consideration was not incorporated into any of the past legislation, only with respect to the core pension benefit. Similarly, a catastrophic disability might provide the member with more salary protection if it occurred as LEOFF 2 service than if it happened during federal service. There was no consideration for that potential discrepancy as well.
Okay, any further questions for the Colonel? Anyone? All right, sir, thank you very much.
Thank you for your time.
Appreciate you taking your time to share with us. So Ryan, can you jump up here real quick and put us back on our screen on our two options there?
Now, before, by way of background here, Mr. Chair, members of the board, the Select Committee is also studying this exact same issue. Their meeting will take place the day before your December meeting, so staff is still coordinating. With respect to this specific issue, the Select Committee chose to have Senate Ways and Means Committee staff take the staff support lead on this particular issue. They were looking to divide up workload between legislative staff and Select Committee staff. And this particular issue was passed off to Legislative Committee staff. So with respect to that, there is no defined bill language or anything like that for you at this moment. And the Select Committee is going to be wrestling with some of these same issues that Representative Holy and others have brought up in terms of what do you do about the fact that there's going to be some discrepancies with some of these ancillary benefits? Should that be a part of this bill? What do you do about questions of that were raised about when a governor declares versus when the federal government declares, or how do you distinguish between what type of service the injury occurred in, whether it was line service versus administrative service, for instance. And there are no answers to any of those questions, at least right now, because the Select Committee is still considering it.
What we need to do here from our perspective is just keep this issue moving forward pending the outcome of the Select Committee's determination.
Yes, you could still decide to do a bill that would be left to only in December. If you move the issue forward today, then in December, we will be able to tell you what the select committee did, and you can either endorse that same proposal for left to, or if the select committee did nothing and you still want to move forward with left to, you could do a left to only bill.
Okay. Mike?
Mr. Chair, I move option 1.
Okay, it's been moved and seconded. Further discussion?
I have a question or comment. It says here, if I recall the presentation correctly, we were talking about the governor activating troops, and then we were talking about the federalization of troops, whether it's Title 32 or Title 10. Option 1 only discusses federal service. Doesn't say anything about state service.
We'll make sure that that's clarified, but it would apply, the proposal would apply regardless of whether it's the
Governor or
yes, federal.
Okay.
Okay, Jason?
Clarifying statement on when we were discussing whether federal or state. My understanding it's all federal, but it depends whether or not they're going to do something that's a state activation versus a Title 32 versus a Title 10 or a combination of all, correct?
Yes. Part of the distinction is there's two kind of lever points. One is who calls them up, whether it's the governor or federal government, and then the second lever is who's paying for them, whether it's the state or the feds. And so between those two things, you can end up with a total of 6 different
Okay, just
several
to follow
different
up,
combinations.
the way I understood it was Title 32 and Title 10 is federal money. If the
Yes.
governor calls them up, it's state money.
No. Under state, the governor calls them up and it's state paid. Under Title 32, the governor still calls them up, but the federal government pays. So Katrina would be an example of that. They were actually activated by the governor, but the federal government assumed payment. So that primarily what this proposal would cover is mainly the first two. The state call up for things like flood, which have no federal component at all, or the state call up for events that, like Katrina, where they're activated by the governor, but they are with approval. There is the possibility in an extreme event they would also apply the third category, which is they'd be called up into usually the third category is like military action during wartime. Maybe in an extreme example, the colonel mentioned like a major earthquake with tsunami on the Cascade subduction zone type of disaster, that there would be a call up for more general type of response rather than just that specific rescue.
Okay, on the motion. Motion is to move option number 1 to the December meeting. All those in favor, please signify by saying aye.
Aye.
Opposed? Okay, that is adopted. All right, thank you, Ryan. So, Teresa.
Thank you. After listening to that, I actually think trying to figure out your various analysis on benefits is easier than, or is tougher than being a global asset manager. But actually, I'm glad I got to listen in. My husband's a volunteer firefighter. He often gets called. He's also a state employee. He often gets called out. He was on the Carlton complex for 3 weeks this summer. And it's always a hassle when he gets back at L&I to try and figure out who covers what benefit when he's on these fires. So anyway, I can relate to your last discussion. Good luck in figuring it out. So this is my annual opportunity to come before you, talk a little bit about what's going on, but I understand there's a few new members of this committee, and so for those of you who've heard some of this before, bear with me, but I do like to just give a brief overview of who the WSIB is and basically what we do for you. At a glance, we're one of the largest and most diversified institutional investment managers in the U.S., $106 billion in assets under management. To give you some perspective, we're about the 33rd largest pool of institutional capital in the world. The reason for that is because we have consolidated all of the various retirement systems and other state assets under a single roof at the WSIB. The size allows us to have scale and be global. We actually have assets in 74 different countries, 6 continents, 49 currencies, and currency lately has been something that's moved against us. We have a lot of exposure in emerging market currencies, and the dollar is strong right now, which is good for our country in certain ways, but it's bad for our emerging market holdings. And we have more than 12,000 different investment holdings. And I think you're very aware that we historically have delivered very strong returns for you and our other pension clients. One of the things that the legislature did that was very forward-thinking in 1981 in creating the State Investment Board and bringing all of the various state, city, local, county pension systems under a single roof. So that was done in 81, and then in 91, the decision was made and legislation supported to combine all of these assets into a single commingled trust fund. Again, the advantages of that is with that kind of scale, the WSIB was able to hire professional management, both the staff. We also have access to really some of the best investment management firms in the world, the best thinking, the best ideas, and it allows us to be lower cost because we're essentially spreading the costs of consultants, staff, et cetera, over a large pool of capital. Many other states are still splintered and don't operate that way. If you think, probably a lot of you have colleagues in other smaller single firefighting funds across the country and law enforcement funds, and those small pools of capital just aren't able to access the same kind of deals that we can as a larger system. This shows the growth of assets under management over the years, going back to 2006, so you've got a 10-year history there. You can see that markets have turned a bit against us in the last 6 months. So fiscal year to date of 2016, we've actually had a reduction in total assets under management. And then down at the lower left-hand side, you see that even though we manage a lot of funds, the bulk of them are still the retirement funds. One of the things, again, that the legislature was very forward-thinking in designing the governance structure for the WSIB. We have 10 voting members that are drawn from a very diverse group of system owners, and currently Kelly Fox is the vice chair of our board and represents all of you and your interests on the board. But if you look at this list of representative members, there's no single voice that can control the board. You get a real diversity of opinion and views and stakeholder interests, and I think that has served this organization really well over the years. You would think with this many diverse views that you might not lead to the best decisions, but in fact, behavioral finance, behavioral economics shows us that the more views you have at the table, the more perspectives, the more backgrounds, the better investment decisions you get over time. The 10 voting members of the board select 5 investment professionals that also advise them. And I always say, in essence, then the voting members, represented here by Mr. Fox, get the best perspectives of staff, the best perspectives of the consultants, and then the independent perspective of the investment experts that they select. So they're really getting sort of 3 views on the markets and on individual investments, which I think really benefits us. Just looking at, I mentioned earlier, the geographical diversification that we have. This is a nice visual of it. I've shown this chart before. The numbers do change year to year, but not so much because our focus has changed across the world, but basically North America has emerged from the recession much more rapidly than Europe and other countries. So a couple years ago when I presented this, we had about 55% of our assets in North America. Now it's 60%. Again, that's not because we're pivoting our investments back to North America. It's simply the valuation. The values of our holdings have increased. Europe a couple years ago would have been closer to 20%, but Europe is depressed right now. And so the holdings are not worth as much as they were previously. As a long horizon investor, we think it's still important to be a global investor, even though right now North America is doing better. During the recession, the emerging markets did better. So it's really difficult to predict these things ahead of time. And because we are a large asset owner, we're not very nimble. We're like the cruise ship versus the jet ski. It takes us a lot longer to make adjustments. So we essentially set up a program that we think over time, over decades, will do well for us. In addition to geographic diversification, we also think it's important to be diversified by asset class. And this is an illustration of basically not asset classes have different risk-return profiles, and this is an illustration of the risk-return profile of each asset class. And you see there's a lot of overlap. So fixed income, treasuries, traditionally viewed as the safest kind of investment that you can have. So fixed income is over on the low risk side, but if you get into high yield or into credit or emerging markets, they actually have some overlap with a risk-return profile of real estate. In real estate, you also have a broad risk-return, basically range. So unlevered versus levered, developed markets versus emerging markets. So developed markets like the U.S., Europe, Japan would typically be considered lower risk than emerging markets like China or Brazil. And then within real estate, fully developed land, if you purchase something that's already an existing asset that has an existing cash flow attached to it, that's going to be a more predictable return, lower risk than, say, taking on raw land, taking on the development risk. And again, we have assets across all of those risk spectrums within real estate. Similar story in public equity stocks. Developed markets like the U.S. are not as volatile and as risky as in emerging markets, and we're certainly seeing that play out right now in today's markets. Emerging markets are extremely volatile. As China slows down, a lot of the rest of emerging markets are slowing down, so you see a lot of volatility within those stock markets. Large cap, such as the Dow Jones, is going to not have as much volatility as small cap stocks. And then in private equity, again, some private equity is more risky than others. Venture is probably considered the riskiest. You know, in venture, you're lucky if 1 in 20 investments is a home run, but that single, if you're in Uber right now or Facebook or any of these, those are the 1 in 20 that have made it and done well, and they can make up for the returns of the poorer performing. So again, in private equity, we tend to lean more toward the lower risk categories within private equity, but we still have a little venture exposure in that portfolio. Looking at the purpose of having a diversified asset allocation, I thought it would be worth talking a little bit about it. They all have different objectives beyond just the risk-return profile. For public equity, in addition to just the capital appreciation, the public markets do tend to outperform, obviously, the bond markets over time. But it's also a provider of liquidity for us if we need to raise cash, which of course we do. We pay out about $2 billion in benefits a year to pensioners. When we raise cash for that, for capital calls, when we're funding a new investment in real estate or private equity, we need to be able to raise that cash quickly. And of course, we look to the public markets to do that. We can sell those stocks immediately. Fixed income is also a liquidity provider, but probably more importantly, it's a diversifier. Bond returns, as we all know, are very low right now. So some people would wonder why we'd have anything in bonds. But if just look back to the financial crisis, and in the worst of the financial crisis, the bonds were absolutely the best performing asset. We earned about 18% in 1 year, the year of the crisis, and that was when the public markets the stock market went down about 40-some%. So again, even though right now returns are low in the bond market, it's an important diversifier. We have about 37% of our assets are in public equity, 20% are in fixed income. Oops, sorry, go the other way. Private assets, WSAB is known for its large allocation to private assets. And so if we look at private equity, again, the primary purpose of the private equity portfolio is to earn a higher return. We typically our goal is to earn about 300 basis points or 3% over the public markets. And we have consistently done that. I'll show you the results at the end of this presentation. And then real estate is somewhere, as you saw on that chart, between the risk-return profile of bonds and private equity and public equity. So real estate, its purpose, again, it's a diversifier, but it's also probably more importantly generates cash flow. Of our 8% return target for real estate, we get about 5.5% to 6% of that is from cash. And again, we pay benefits with cash, and so that cash flow is very important in our real estate portfolio. Also, a new asset class that we've just had up and running for about 3-4 years now is our tangibles asset class, and that's things like timber, agriculture, and those also are primarily for cash flow and also inflation protection, because those assets tend to increase in value with inflation. One of the reasons going back, private equity, our current allocation is 23% and real estate 15%. Tangibles is up to 5%. So if you add all that up, we have over 40% in what you would call private markets. Some people would call those alternatives. I actually think alternatives is the wrong term, because I think they're sort of basic real economy kinds of investments. Alternatives like hedge funds, which are more financial engineering kinds of assets. These are not those. These, we actually own real things that you can touch. So I think of them as not so much alternative as real economy assets. One of the reasons we like private market assets, besides their nice return profile, but I heard someone describe that private assets are really not so much an asset class as they are a governance structure, and I like that, because if you're buying or selling, or if you're in the stock market or bonds, you have a buy decision and a sell decision. You have no governance rights over that company. You can't change anything operationally in that asset. The private asset toolkit is much larger. So you can buy it, but then once you buy it, during the buy decision, you can structure the deal in a certain way. You can retain certain governance rights over that asset, the ability to hire and fire management. You can apply financial leverage if you think it's appropriate at the right time. You can restructure the operation. You can create management incentives so management is completely aligned with you as an investor. You can help set the strategic direction of the company, and then ultimately you can sell when you think it's the right time. So one of the reasons we've strongly have made these large allocations to private assets is because we do think that there is more better governance and more control over those in the long run. The other thing is we can choose to hold them long term, and so we can ride out market cycles. Some of our results, again, getting back to the scale, even though we have a very large allocation to private assets, which are more expensive assets to run, we pay higher manager fees in those asset types. But because of the scale we have, we are still a relatively low-cost fund. So we're able to provide you, as our client, access to asset classes that are typically expensive, but because they're spread over a large pool, we're still a relatively low-cost provider. The result, I mean, I think all of you talk to your peers in other states, and we're in good shape, especially your funds. We're well funded. And this is according to the Pew Charitable Trust. We used to be one of what would they say one of the top 4. We're now within the top 10. Primarily, it's because the actuary's recommendation to adjust the experience tables, life expectancy. We took that hit on our portfolio sooner than other states have taken that. So in other words, we've increased the liability profile because of that decision to incorporate the new actuarial longevity tables. So the good news is we're all living longer, but the bad news is it means it costs our system more. But we're still in the top 10 funded states nationally. And then probably one of the things you're most interested in is performance, and I wish this was a better performance picture to give you than in previous years. If you look down in the lower right-hand corner, you see our 10-year number of 6.73%. I've been here 12 years. It's the lowest number I've ever had to present. Markets are tough right now. October number's a little better at 7.2%. I didn't have that for this in time to put it in the slides, but I did get the October numbers, and so it's come up a bit. But we are in a period of difficult markets. Also, when you look at the return profile, we've had some of the really good years drop off, and we have. This is the entire recession, so those numbers we expect to get better over time. If you look to the lower left-hand corner, we still have a since inception return of over 8.5%. So we're still meeting the goals of the fund, and our 5-year and 3-year numbers are looking fine. In terms of outlook, we do think we're in a bit of a tough environment going forward. This is something the board is going to have to grapple with over the next year, and we're going to then have to advise the legislature on what we think we can earn over time. The low interest rate environment is difficult. The whole world economy is slowing down right now. So we don't think things are going to be particularly easy. The one thing that we spend a lot of time on is, even though there's macroeconomic headwinds, there's always opportunity, from a bottom-up perspective, to continue to find good investing opportunities. And we have staff literally scouring the globe and investment partners scouring the globe for those opportunities. But I do think we can expect a bit of tough sledding going forward. So with that, I'll take any questions that you might have.
Thank you, Mr. Chair. Not a question, just a personal privilege to editorialize just a little bit here. I attended a international symposium on private equities at Cambridge a couple years ago here, and I really want to compliment you. The SIB and you in particular are known and acknowledged internationally for the performance we've had through the downturn, and the I don't know if visionary is a good word, but the foresight to place investments in such an area as to protect us and keep us in the positive, in the black throughout the downturn when so many other systems out there were failing. And they said this is something that literally was because you had the foresight to allocate more than other people probably would in private equities and some of the positions you took in the Tier 1 equities, because you're ahead of the game and able to cherry pick the things out there. And I just wanted to say thank you, because as I look around internationally and all the government systems that are represented, they acknowledge this system and you in particular as having done an outstanding job.
Well, thank you very much. I want to pass the credit to the board. Washington is unusual in that it has a board that's willing to take risks and be different. And sometimes we're a little contrarian to some of our peer funds, but I think it's served us well. I think this tangible assets portfolio that we're building is going to be the thing that, say, a decade from now we're going to be known for having been ahead on. These kinds of assets in agriculture, timber, infrastructure are relatively new assets for institutional investors, and so it's taking a lot of work to figure out how to best implement those programs, and we've got a great team doing that. one of the things that is I'm in the process of working with the management team right now to figure out what our strategic plan will be for the next year. And I think one of the big things is to really sort of step back and think, okay, what are our core competencies? What's going to be important to us in the future, and really have a good conversation with the board over what are our strategic advantages going forward. And I think it's so critical to do that right now because we do think it's going to be a tougher investment environment. But thank you. I'll pass that on to the team. Any other questions? So Steve, did you want me to address the issue of the health benefit, the benefit improvement account, or were you going to bring that up with the board later?
No, other than just to provide them the
Quick update, yeah.
the budget proviso that funded the benefit improvement account out of the left to fund didn't have a date on it. So as originally the transfer, if it was out of the general fund, the original legislation had provided that that would be by September 30th. The budget proviso didn't have that. So SIB's been working on that and doing a great job of ensuring that this new type of payment meets federal tax requirements for a qualified tax plan, and the timing of it is handled so that it doesn't disadvantage the commingled trust fund or the left to fund. I will say, working with their team on this issue, they've been very cooperative and very informative throughout. And expect that transfer will take place, barring anything unexpected. It should be shortly, but it hasn't happened yet.
Yeah, the challenge is there's very, very strict rules around what is a qualified asset. And if we were to, this is in a sense, I think your goal is that it become a sub-account of the commingled trust fund. I don't think you want it taken out and invested separately from the commingled trust fund. You want it in the CTF, and it's critical that we have very strong legal foundation for that being a qualified plan asset, because if not, then it essentially taints the rest of it, and there's huge tax implications. So Steve's team has been patient while we work through that with our AGs and outside counsel to make sure that that takes place. We also know you're anxious to get that moved because it was a set dollar amount rather than a percentage. But frankly, the set dollar amount right now is benefiting you, because if we would have transferred it during the last few months, the markets have been down. So you've benefited from our delays. But we're working on that. We'll make that happen as quickly as we can.
That's because I'm vice chair that they held off on that. So. In fact, we have our chairperson in the back of the room there. Marcy Frost is here. So I want to add my kind of comments here at the end that it's been an incredible opportunity for me to serve on that board, and the leadership that Teresa displays there, leading the entire organization, and then Gary Brubaker with the investment team. They just do an incredible job there, and we participate in almost every facet of this this operation. We're in on almost everything. It's well thought out, well discussed. Our 5 non-voting advisors are there the whole time, and so I think what happens for us is having the diversity of the people in the room keep us all heading in the same general direction, and the diversity of thought is just really helpful in the overall scheme. And you look at this chart right here, and I think that's a testament to the foresight of the folks that brought this to Washington State, and the good leadership that we continue to have with Teresa there. So thank you very much for your presentation.
Great, thank you.
All right. All right, we're going to have the director at the Department of Retirement Systems, and then we'll take just a quick break as soon as she's done here. But they have real jobs to do, and they got to get back to those. So
that's fine.
All right, Marcy, thank you.
Yeah, thank you. Good morning, everyone. Good morning, Chair Fox. I haven't seen you for a few weeks, and members of the board. wait for my presentation to get loaded here. Can I do it? Whoops. Okay. So since our last update to you, the department has really continued on the journey of making the changes, of being much more customer-focused as an organization with high levels of team engagement. I'm just getting over some crud, so if I sound a little different, that's why. And I have my little understudy, Dave Nelson, back here, who may have to come in and pitch in if this doesn't go well. So again, being customer satisfaction driven, high levels of team engagement, we'll show you some recent data on how well the organization is doing in both of those areas. Oh, thank you. So this chart, or this data we show quite frequently. It gets really at the size of the organization being the umbrella system, and Teresa talked about that in her presentation a few moments ago. Our peer group is really the largest U.S. plans, so it would be the CalPERS, the CalSTRS, Wisconsin, Texas teachers. So the dollars collected, you can see, coming both from the member and the employers. Dollars paid, actually $4.1 billion. And the good news there is that over 90% of those dollars are staying in the state of Washington and being spent in the state of Washington. Team members, relatively stable number of team members for the last decade since the Plans 3 came in was really the last time that any FTE changes happened within DRS. So that's a number that remains pretty static, even though workload does seem to be a little more volatile. Employers, again, that's a number that stays relatively static. Spokane Transit Authority, I think, was the largest employer who came in more recently within the last 5 years. They brought in about 500 new members to the system. So on plan members, a little over 700,000 total. The number here to pay attention to, I think, is really the number of inactives in this system. We are definitely an outlier in comparison to our peers by the fact that we have almost 250,000 inactives. And inactives are people who have worked in one of the plans, so have earned service credit, may be vested, may not be vested, but have left their money on account with DRS. And one of the reasons we think they leave their money on account with DRS is that we pay 5.5% interest on that. So, and if you think about having your money in other places, it's very unlikely that you're going to earn 5.5% interest. So this is something that we will be looking at over the next year. We have been looking at it over the last couple of years, but we do have some lawsuits that are out there regarding interest and the way that interest was applied during the transfer windows between plans 2 and 3. So that has slowed us down a bit, but we are planning on looking at that policy and adopting a new WAC. Workload has increased a bit, both on the number of retirements as well as phone calls. When we separated the jobs into contact center and processing center, we saw that the phone calls, not the volume so much increased, but the call duration has increased pretty significantly. And we anticipated that that would happen, and it's something that we had planned for, because prior to our reorganization, what we found is that some of the behavior within the phone calls was that we were trying to get people off of the phone call because the processing work was happening. And so when we did these team engagement interviews, what we heard from our employees was that, the phone calls are interrupting the work. Well, the phone calls are equally important to the work. So there's the contact work and there's the processing work. And each one of those needs to have the same level of dedication and resources. So call duration, and we're still trying to get stabilized in that reorganization that was put in place 2 years ago. So we do have an annual cycle for strategic planning, and this is where we bring in new items, so new functionality, new services for members or for employers. And then we also take a look at what might be broken in the operational side that needs a new capability improvement. So one of the reasons that strategic planning works pretty well at DRS is it gives clarity to the agency about what we will work on. We tend to have a very high appetite for change, and we have a lot of team members who have ideas about how to make pretty significant changes in the organization, but we have very limited resources to be able to do that, and especially in light of the fact that we have 2 major initiatives happening right now, which I will talk with you about a little bit later. And then we also have a separate project management office called the Project Management Division, and this really sets their workload for the next 1, 2, and 3 years. So that's really important to give them the direction about what they will be spending their time on. So this chart is a little dark, so it might be a little difficult to read, including for me. So a couple of areas here to call out is the my glasses, the record keeper enhancement. So one of the things that we felt was important to remove some of the complexity for the membership as well as for the team members at DRS was really to move into a single record keeper model. So right now, if you're a Plan 3 member and you have a DCP account, and of course you have your defined benefit with us, at the time that you were going through retirement or had a need for service, there was a chance that you would talk to 3 separate organizations to really get the full picture of the question that you were asking. So one of the things that we did in our last renewal cycle for the contract was see if we could get to a single record keeper model. And we are now in the process of transitioning to that single record keeper. We chose Empower Retirement Services, which used to be Great West. The parent company has stayed the same as Great West Life and Annuity, but the retirement side of the division or the company has moved to Empower Retirement Services. So what you will see with that change, and that change will be effective March 1, we actually did do a delay because we didn't feel like the project was ready to move fully into production, and that it would be a seamless change for the membership. But post-transition, some of the things that you'll see is we want to bring the Roth IRA into the 457 plan. We have a number of members who are asking for that feature to be available. So that might be something some of your folks would be interested in pursuing as well. We also just going to talk with some of you about this as we're moving forward, but the ability to offer loans through the 457 plan. So when we're talking to other large public employers who may want to transfer the 457 administration to the state, i.e. DRS, one of the things that they would like to see is the ability to continue offering loans. Typically, their programs currently do that. And so there is a request that we at least take a look at loans, the Roth IRA, and then the ability to offer a 401A, which would require new legislation to be able to do that, which is the second one, which is the opt-out enrollment or auto-enrollment. There was a bill last session that did not make it out of the Senate that basically would do auto-enroll for state employees, all new state employees, but also had a piece of the legislation that local government did not care as much for, and they testified pretty clearly about that, that they would have to offer the state's 457 plan as a part of their lineup. Not the only offering that they would have, but it would have to be offered in addition to anything else that they may be offering. And that was not a popular piece of that bill. So we'll continue to work with the plan sponsor. Jacob and I have a meeting this afternoon with Senator Bailey to talk about opt-out enrollment for state agencies as well as offering a 401A. So the 2 significant initiatives that are going on are the record keeper transition, and then the other one is the replacement and update of the IT systems that are operated within DRS. And the first step of that is the employer reporting application, and we're starting there because that's the furthest upstream piece of the system, and it was the first system that was actually created back in the 90s. And so this will make it much simpler for the employers to be able to report their data as well as report their contributions. Much more simplified ways of doing that than they have today. So we're not necessarily in a quiet period, but the RFP has been out. We have vendors who have responded, very highly qualified vendors. We're very pleased with the response that we've gotten, and we'll be announcing an apparently successful vendor, I think, at the end of this month. So those 2 projects, just based on the amount of resources that they're taking to get implemented, means that many of the other strategies need to be a little smaller focused. And so where we typically get those is from the customer satisfaction interviews that are done every month. So that's the strategy side. We also spend much time measuring operational excellence and operational performance. So again, I talked to you about, our goal and our vision really is to have high levels of customer satisfaction and make sure that our teams have what they need in terms of tools, resources, leadership to be able to successfully meet the needs of those customers. So our system has an emphasis of connecting every single team member in, meaning that their desk level and the processes that they're operating at their desk level, they're able to see whether those processes are on track or off track, and then we engage with them on problem solving when things are not on track, the performance is off. We want high levels of self and team accountability. We have changed the hiring processes pretty significantly. One, to hire people who are naturally inclined to be more self-accountable, but also accountable to their peers or to their team, and ultimately accountable to their customer. We want problem solving by everyone, and we want a common language about how that's done. I think in the past, the environment that we really moved out of is that the problem solving was only done by management, and it wasn't done by the people who are doing the work, right, who are working closest to those processes and closest to the customer. So what that means for our leadership is they have to get much better at facilitating those problem-solving conversations and problem-solving discussions with their team members. Rather than solving the problem, they're helping people teach and coach them on how to solve those problems. And that leadership needs to be very supportive and engaged and out observing the performance of their team on a regular basis. So here's the customer satisfaction data, and you'll see Dave's name is up there. So one of the components of our system is that there's a single point of accountability for every core process, and a core process, of course, being customer satisfaction. Dave is the owner of that process across the entire agency. And the numbers are actually pretty good, very good, other than they're in the middle there, where we struggled with follow-up. And because these are interviews and they're not surveys where you're asking for a ranking and maybe you're not getting many comments or data that would be actionable, we actually get actionable data from our customers when we do the interviews. So in this case, what we heard is that many people want to use the online retirement application, but what was happening is that they submitted their online retirement application 2-3 months in advance of their retirement. They weren't hearing anything from the department about, was my application received? When is my first benefit payment going to be received? Did I get all of the paperwork in as I was supposed to? And so as those interviews were being done and we were hearing this, that data was then sent over to our IT department, and the IT team, along with the business team, developed out some follow-up actions, and I'll show you what that looks like also, just a couple more slides down. But there are 260 interviews were conducted in the quarter, and the people doing the interviews are every leader at DRS. So whether you're in IT, whether you're in retirement services, whether you're in fiscal, whether you're in executive, every leader in the organization has to do at least one customer interview per month. And then our green belts and our black belts also do them because they want to be and remain close to the customer as they're looking at their work on how to make improvements. So team engagement, that tends to be a little more volatile. Change is bumpy. So, our goal is to make sure that customers have what they need to be successful. And as you saw in the former slide, that we're doing a pretty good job there. The team engagement side tends, like I said, to be a little more volatile. So one of the things that we watch for is the bottom, the pursuit of excellence. And, people, know the agency is trying to get better. We're trying to do the right thing. The customer focus remains in pretty good health as well. People in team focus, it's rare that we've seen that actually be in green status. Supportive and engaged leadership, when we first started doing this measurement, and we rate this on a 1 to 10 scale, we had a 28.6 rating when we first started. And supportive engaged leadership was in full red for the first year that we did it. So we've made market improvements in not only hiring the right types of leaders, but making sure that the leaders are demonstrating the correct behaviors day in and day out. Open and transparent communication is one that we have always lagged in. And even with the actionable data coming in, so how we get this data is that we have a group of DRS team members called the guiding team who will go out and interview their peer group within the agency. And very similar to what we do with the customers, it's rated on this 7 criteria, and they give us a 1 to 10 score. Those interviews are then debriefed with the entire management team or the executive team at DRS, and then we determine the actions necessary for the next quarter to hopefully move these numbers back into green zone. Open and transparent communication, again, is one that we've really struggled with. We brought in huddles. We stopped any meetings from being scheduled between the hours of 8 and 9 a.m. in the morning so that the huddles could actually happen. We want to use huddles as a way of promoting good communication amongst the teams. But there tends to be, what we hear here is more need for hand-feeding information, right? So information is out there, but we have to find a way to make it easier to retrieve. And we're still struggling with that, obviously, and trying to figure out how to make that work. And then learning and growth, you'll see some improvements there, and I think this is primarily related to we updated our tuition reimbursement policy. So people who are pursuing degrees, we're going to give a little more money to them to be able to finish out their degree programs, and then try to find ways to be a little more flexible within the work environment or the work hours, that they're able to take some of those classes and make up time during that work week. And then we just implemented or just started our new guiding team. The former guiding team had been in place for 4 years. They put all of these pieces in place, created a great foundation for the new guiding team to come in, and there are 14 new members who are coming in to do these interviews and help with change in the organization. So one of the things that we heard very early on in our team member interviews is engagement means that people's ideas are actually implemented. So in the past, management would get an idea from one of their team members or from one of their staff, as we used to call people, and they would maybe sit on that idea for a period of time. And so people didn't feel like their ideas were really moving into implementation or into a system to be adopted. So we wanted to fast track that, and we brought in a product called Idea Scale. And this is where, if you're a team member at DRS, under certain campaigns that are up there in that left corner, so enhancing services and value for customers, increasing efficiency, preventing waste, and the third one. But anyway, there are three campaigns that people can put their ideas into. So you can, as a team member, you can go in and submit an idea. You get voted on. You get I agree or I disagree from your peer group. You also have your peers who are coming in and commenting on whether they think it's a good idea or how to make that idea even better. So after those sit out there for a period of time, our black belts then take all of those ideas and they rate them into what we call the magic quadrant or the priority quadrant. And the priority quadrant is based on, to what extent will this add customer value and to what extent will this cost the organization. So the upper left is where you want to be. That's the magic quadrant. That's the high customer value, lower cost. If it falls into the upper right, that's more the strategic. Those are more strategic items that would go in through our annual strategic planning cycle. You might get some in that lower left, which would be the quick wins. And typically those are done in coordination with that magic quadrant. And then the lower right is really what we call the opportunity bucket, which means the idea isn't either fully vetted out or it's not a good idea. And we're very quick to talk with people about not every idea is a great idea. We're not going to implement every idea, or should you? And if it falls in that opportunity bucket, it's really an opportunity for you to go back out and improve upon your idea. So here's the data, the stats on how the organization is doing. We have a goal that we implement 10 new ideas per quarter. And you'll see that this last quarter, 51 ideas were implemented. And these are ideas coming from team members and not from management or leadership per se. And we believe that engagement is there's a high correlation to productivity. So this is our fundamentals map. I know you've seen this before. This is the operational view of DRS. It is how we make the complexity of what we do more understandable to the people who have to do the work. And I talked a little bit about the accountability that every single one of the core processes has a single owner. So if Dave owns paying benefits and we have a problem in our IT area that's causing that performance to be off track, it's still Dave's responsibility to go through and clear up that problem that's happening in IT and work with his peer. He's the one who's accountable on reporting out that performance in the quarterly target review. So the upper level, all the way down to the sub-processes, each one of those have performance measures attached to them, and they are scorecarded on green, yellow, and red. So we're a little over 2 years into the quarterly target reviews. These are done in front of every leader in the organization, every black belt, every green belt. And we believe that transparency is really part of the key to keeping people engaged and keeping them solving the right problems, the big problems for the customers or for the team members. We use the CEM adage that what gets measured gets managed, and we firmly believe that. I would say in the past, and Steve, I know when you worked there, there was a bit of this going on, is that if there was something in red, i.e. it was off target, typically what would happen is there would be a who conversation, not a what conversation. The QTR was really a what conversation. It's not who did this or who caused that. It's what's going on in the process that isn't acting in the way that we predicted it would act. And how do we use data? How do we use our lean green belts and black belts to really identify the root cause of that problem before we throw any solutions at it? And so we really wanted an environment where everyone felt engaged, everyone felt like problem solving was their job. And so we have this quarterly target review process, and we record it so every team member is able to go back and take a look at it, because we can't have the entire agency attending these every quarter. But it has promoted high levels of accountability throughout the agency, not only in leadership. So here are a few measurements out of the quarterly target review. The cost effectiveness one, I know that Mark presents the CEM data to you. And so the first chart is really the difference that we want in our predicted cost versus our actual cost. So there's about a 30% variance there, which means that some of the efficiency initiatives that we've put in place are working. Estimate accuracy, that falls under paying benefits, and that is Dave's as well. And Dave can correct me if I'm wrong on this, but this is when we give someone an estimate, we want that to only be a 5% difference between what their final benefit actually is. People are making very significant decisions on that estimate that we're providing to them, and timing of their retirement. Can I really afford to retire? What will my benefit be? So we want that to be within a 5% up or down on the final benefit, the actual final benefit. One of the things that we're really focused on is trying to stop employers reporting to us via paper checks. We have a cash room still within the agency where we take in all the checks and we reconcile them and get them sent off, where they need to be. But we also have an e-pay system that would allow employers to completely report their contributions to us via electronic means. And so continue to work with those employers to get that number down significantly. And then online retirement applications, that's obviously where we're spending a lot of our resources to improve the online channel. And over 50% of the applications in July came in through the online route. And we think that's the best service for the customer. And the contact center is still there to help people make sure they understand their benefit. But the transaction of submitting your online retirement application rather than filling out all of those paper forms, filling out the same information over and over and over again, we believe that the online retirement application is really the best way for members to see a full picture of what that would look like. So this chart is for your reference, and we went ahead and had this separated out so that you only see the benefits paid to Left 2 annuitants around the state. This is also available on our website that shows for all systems, all plans, but you can also break it down by Left 2 on the website if you'd like to. But again, for your reference, and shows where the dollars are actually going into by county. One of the things that Left 2 has been known for from the inception of us really working this online channel is you were the earliest adopters. You are continuing to be the earliest adopters, not only on online account registration, but also using the online retirement application. But the percentage overall now has grown from 64% online account users to 66.4%. And we'd like to obviously get that up into the 80% range, if at all possible. But we are at the highest level since that measure started. This is the new retirement tracker, and this is what I referred to back in the customer satisfaction data where we were seeing the yellow indicators coming in on follow-up or being informed of status. So you see in the middle of the screen the green, green, yellow, kind of the breadcrumb trail of the steps that you need to take to submit your retirement materials to the department for processing. If there is a step that you haven't taken or you're only partially complete, it will either give you a yellow status or a red status, so you know where to go to immediately. It's also sending you emails throughout this process to keep you fully informed. That change alone moved the customer satisfaction data in that area out of yellow back into a very healthy green zone. The IT department is now working on what we call our second sprint, or third sprint, I think, for this year, where you'll be able to go in and update your banking information through online account access and update your beneficiary information. And those are expected to be put in place by the end of the year. So another kind of a focus area for us, and we've been working with your team here at the LEOFF 2 board for disability determinations. And as you know, the benefits continue to change on disability, primarily in LEOFF 2 State Patrol, it is increasing in complexity and increasing in volume. And the way that the agency has been staffed in the past with an occupational nurse consultant, we believe that that resource may not be sufficient to do this the way that it needs to be done. So we are seeing a higher frequency of PTSD claims and multi-causal claims coming in as the population ages. And so we want to look at other ways to make some of these determinations. And we know that you want these determinations to be accurate. You don't want them to lean toward being too conservative or being too liberal. And so I think what we're finding is that we need to have access to many more independent medical reviews than what we've done in the past, and also other sources, other physicians, other doctors helping to make that determination or make that determination on the behalf of the department. So we'll continue to work with Steve. I know Steve was at the last meeting that we had with a particular vendor who offers a service like this. They tend to be a little expensive, and so we want to make sure that we're getting good value for you all. If we're going to outsource this, make sure that the value is actually being returned on the work, and that there's a high level of customer service with these individuals who are going through this process. Some other work that's happening: the public safety officer tax exemption. We did work with the Health Benefit Exchange to make sure that they would receive the deduction if there was a carrier through the HBE, through the exchange itself. But there was a statutory change in 2015 that restricts payments to carriers out of the exchange. So the payment must now be made directly to the carrier. And for the most part, I think we found that most carriers take the deductions from DRS, but there are a few who do not. And
the system has detected that this conference has reached the duration limit for 3 or fewer participants and will now...
Is that my cue?
Yeah, you're done.
Okay. Give her the hook. Yes, exactly.
Well, I see you only have like one more slide.
I only have one more slide. I'm trying to get through this. So we can't require carriers to take payment, but any time we encounter a problem like that, we'll reach out to your director, and this might be an area where the board or the LEOFF 2 staff can get involved if we're finding some problems there. But we'll certainly stay in coordination with you if we find carriers who will not do this. So the other, I did talk a little bit about this. This is our other major project. The legislature did give us the funding, about $10 million, to begin modernizing the IT platform at DRS. And we run our own platform, so we're running our own payroll system to pay out those $4.1 billion and to receive that money and those contributions and to do all the benefit administration. Those are systems housed at DRS, maintained by DRS fully. We have a few, contract staff who help during legislative session. If there's a bill that gets implemented that has a really quick turnaround time, we can contract some of that programming out to help the IT team. But this is a system that's completely supported within DRS. And we want to continue that model if we can. We want to be as self-sufficient as we can, which is why this BPMS architecture is something we're very interested in, and that's a business process management system. And so you'll see the timeline. We're not, we think we can move this timeline back. We're putting a lot of pressure on the team to move this timeline back. and to get the employers moving on this a little quicker than what this current schedule documents. But we're hoping to announce our apparently successful vendor by the end of this month to get started. So that was a fairly quick little touch on a number of things that we're working on. It's a busy place, but I think what we've really tried to do is work on the culture, because the culture is where you get the right people who want to work there, you get people who want to stay there. And one of the examples that I used recently is that we used to have a very difficult time recruiting retirement specialists. We would get, we'd have 10 vacancies and we might get a dozen applicants applying for those jobs. And there's a period of time that we're just hiring people because we needed to put bodies in seats. We now get 300 to 400 people applying for the retirement specialist jobs at DRS. And part of that is the culture and knowing that we're trying to, that pursuit of excellence is really important. The customer satisfaction focus is very important. But I think what people really are liking is that our team members are actually reaching out to their friends and reaching out to people they know and say, this is really a great place to work, and we would really recommend you coming here as well. So our interview panels, we've had to make changes to those processes, making sure that we hire the right leaders. We're using some tools to help us do that. I know, Steve, you use those here with your team as well. But the hiring is the most critical decision we make. If we make the hire right the first time, the retention levels also stay pretty high. And training a new retirement specialist is at a minimum 1 year. So it's something that, like I said, we're paying a lot of attention to. So with that, I'm happy to answer any questions.
Any questions? All right. Well,
All right.
thank you very much.
Yeah, thank you.
Also, along with, excuse me, Steve, I want to thank you for the work that you and particularly your understudy are doing out there. So.
I know he actually had to cover for me at the all-team meeting last Monday, and I think he made some joke about having to fill the size 5 shoes. So yeah, my understudy, we wear the same size shoe.
I'd love to see that someday.
Yeah, I'm sure you'd
Can I
be
make a
happy.
quick comment?
Yes,
To
go ahead,
model.
Jason.
All right, thank you very much.
Just real quick, just to
yes.
echo what the chair said. I've had 6 retirees in my agency this year, and they have all said how fantastic it is to deal with DRS. I'm new to the board, so I get some questions. A lot of the questions are, I don't know, I'll get you an answer.
Okay.
But they have all stated that their experiences are well above board.
Wonderful.
So,
That's
and I
great to
truly
hear.
appreciate the millennium thinking that you guys are adopting from what you presented here today. It's very encouraging.
Great, thank you so much, and I'll definitely pass that on to the team.
Thank you.
All right, thank you.
On behalf of my team too, Marcy, I wanted to say thank you. Whether it's Dave or Jacob or Alex, whenever we've needed to work with somebody on a big issue or a small issue, you guys have been great in terms of keeping us informed, sharing with us. You particularly have allowed us, for instance, to participate in the vendor discussion on the medical reviews.
Yeah.
That type of cooperation is greatly appreciated. I wanted to thank you for that as well.
Certainly. Yeah, I think it's a great partnership, and we want to continue down that path, definitely. All right, thank you.
Okay, we're at a point here where we can take a break, and our lunch is ready, so why don't we recess until 11:30, and does that work for you, Lisa, for us? Okay, thank you very much for your patience. And we'll be in recess for about 13 minutes. Make it 12. We'll call the meeting back to order. And the next order of business is Left Plan 2 actuarial valuation results. And Lisa from OSA is here to make that presentation. Welcome, Lisa.
Okay, I'm on now. After some technical difficulties, I think we're ready. It's still morning. Good morning, Mr. Chair, members of the board. I'm Lisa Wan with the State Actuary's Office, and I'm here to present results of the 2014 actuarial valuation for Left Plan 2. So I'm going to go over some of the highlights, and then at the end, I'd like to share some of the changes that the office has been making with regards to information that's in the valuation report versus things we're putting on our website, including some interactive web reports. And this presentation is informational only. No board action is needed today. So starting first with the purpose of the valuation, the 2014 actuarial valuation, which we just completed, is an off-cycle valuation, meaning it is not used for contribution rate setting. You currently have rates adopted through the 15-17 biennium. So the purpose of this report is to look at what the updated contributions would be based on the new data, assets, and in some cases legislation. Also to check on the funding progress. It's always good to keep on top of how's the funding progress going. And it's also an opportunity for the actuaries to certify that the underlying data, assumptions, and methods are reasonable and conform with actuarial standards of practice. That's a requirement of our profession. So in summary, I'll start with the summary and then I'll go through each of the pieces. The market value returns for that period of time ending June 30th, 14 was 18.89%, a little different than what we're going to see next year. Still, it was a positive return for next year, but not as high as the assumption. So it will be an asset experience loss for next year. But this year, ending in 2014, was quite a large investment gain. So the actuarial value of assets now is deferring asset gains of just over $600 million compared to the 2013 valuation where we were still deferring losses mainly from the Great Recession. So now the actuarial value of assets has moved into a different direction. The calculated contribution rates have decreased since the last valuation. I'll go through the different components of that. And the funded status has declined to 107%, but the plan still remains healthy. And as I mentioned, we do look at the underlying data, assumptions, and methods to ensure that they remain reasonable, and they do. So starting with the change in participant data, and this information is in your actuarial valuation. I was asked for a little additional information that I'll share off my notes. It's not included on this slide, but slight uptick in the number of active members. Average annual salary has increased about 3.5% from the last valuation, and very little change to average age and service of your membership. And you can see the increase in the number of annuitants, 453 in 1 year. So some of the other information that was of interest to staff that may be of interest to you, and we can also start to provide this on a more regular basis if you are interested in some of these specifics. The number of new retirees from active service for that one period was 387. So for the July 1, 2013 to June 30th, 2014 period, Left 2 had 387 active members retire. Their average age at retirement was 58, average service 27 years, and their average monthly benefit $4,400. So that was some additional information that I was asked to gather after I had prepared this presentation. And if that kind of information is of interest to you, please let us know. We're happy to provide that on a regular basis.
I think I'd answer in the affirmative on behalf of the board. Those are always, if nothing more than interesting, they're useful for us. And What's the difference, retirees from active versus the number of annuitants? What's the distinction there?
Some of the annuitants are survivors. So if
Oh,
you have
okay.
a retiree who has passed away, or it could be a terminated vested member who now has retired, the information I gave you off slide was actives to retirement.
Okay.
A slightly different number.
So annually, 1366 are something other than retired from service.
Active.
Yeah, from active status.
From this period of time, correct.
Okay.
So on the asset side, when we develop the actuarial value of assets, we first start with the market value reported by the State Investment Board. We calculate the asset gain or loss in that one period based on your assumed return of 7.5%. And then we can develop the actuarial value of assets. And the actuarial value of assets is the asset figure we use for determining contribution rates and also funded status. It's a smoothed asset, and I will show you the impact in a few slides of using that smoothed assets instead of market value. So we smooth gains or losses over a period of up to 8 years. Because of the size of that last investment gain, it was smoothed 8 years. And then we have the 30% corridor, just making sure that the actuarial value of assets keeps a specific relationship to the market value, so it can't get too far outside of that market value. And again, that smoothing method, really the purpose of that is we know assets have quite a bit of volatility year to year, and this smoothing method helps keep your funded status measure and your contribution rates particularly less volatile. So the change in the assets from the last valuation, you can see at the bottom the return on assets from 2013, also a very good year, 12.36%, and 2014, 18.89%. And these are showing just some of the components that go into the asset values. So again, going over the details of the development of that actuarial value of assets, start with that market value, $9.251 billion. And then we include all the deferred gains and losses that are still, what we say, on the books. And we show the plan year ending, what the actual return on assets was for that year, and then the number of years that return was deferred. So if we look back at the second line, 6/30/2013, the 12.36%, that was within 5% of your assumed rate. So it was only deferred 5 years. So we don't defer every asset gain or loss 8 years. It's on a schedule as to how much it gets deferred. So it's just the larger losses that will get deferred over up to an 8-year period. So then this table shows you the years that are remaining in that deferral and how much is still being deferred from each year's asset gain or loss. And down at the bottom you can see the $613 million that is now being deferred in gains. So your actuarial value of assets is now less than your market value. And for several years prior to this valuation, it was the other way around. We were still deferring losses. So as I mentioned, here's a chart showing what that smoothing method is doing for your system. The top and bottom dashed lines are that corridor, that 30% corridor around the market value of assets, and the actuarial value has to stay within that corridor. You can see in 2009 we were almost right on the 130%. But you can see that actuarial value of assets is fairly smooth, and that's really doing what we're trying to accomplish, is keeping your contribution rates from following the cycle of that market value. So you can see how much the market value is changing versus your actuarial value is nice and smooth, and that's what helps keep your contribution rate smooth. So next we'll move to the liabilities. Two key liability numbers I wanted to mention: the present value of fully projected benefits. So that represents today's value of all future plan benefits for your current members. And that for the 2014 valuation is $11.2 billion. The present value of earned benefit, and that present value of fully projected benefits, that is the number that's used when we're calculating contribution rates. So it's that number minus the assets over the present value of future salary. So what hasn't been covered by assets for future benefits will be divided by salaries, because that's how it's going to be paid. Those future costs are going to be paid by future salaries. The present value of earned benefits, that's the same, today's value of all future benefits that have been earned at the valuation date. So it's really based on service. So the first number is using service all the way till people exit the system. The second number, the earned benefits, is just service at the valuation date. So what have they earned for service at the valuation date? And for 2014, just over $8 billion. And that number is what's used in calculating your funded status. So the first number used for contribution rates, the second liability number is used for funded status, because funded status is comparing the assets on hand to the benefits that have been earned to date. This next table shows the contribution rate calculations, and again, this is not a rate-setting valuation, but it does help you see, how the contribution rates have changed since your last rate-setting valuation. We start with the aggregate contribution rate. That's the base of your funding policy, and then we add the entry age normal cost minimum, the rate floor. So you can see that the aggregate rate actually has increased a little bit, but the normal cost under entry age has declined slightly. And right now, the rate that has been adopted for the 2015-17 biennium is 8.41%. So you can see that falls right between the 90% and 100% floor. And as I mentioned, the funded status is taking the smoothed assets divided by earned benefits. It's a great measure for looking at plan health. The last presentation I provided to the board was talking about 3 different measures we use for plan health. This is one of the key ones, and this is also a measure that often gets used out nationally in different reports. And Teresa talked about this as well, how the state has dropped from, I think we were 3rd or 4th a year ago, and now we're 7th, I believe, in the Pew study, so based on their report. And she did a great job of explaining one of the key reasons. The state has moved to fully adopt mortality improvement under our recommendations, and a lot of states have not moved that far yet on mortality improvements. So bottom line, if the funded status exceeds 100%, it means the plan has more than $1 of assets for every $1 of earned benefits. And also it means the plan is on track for fully funding. This table shows the change in funded status from the last valuation. I mentioned earlier that the funded status has dropped to 107%. And a big component of that is the change in the actuarial cost method we're using in the valuation to report the funded status. So if we look at 2013, we were using the projected unit credit method, and the funded status was 115%. If we maintained that same cost method for reporting in 2014, your funded status would be 113%. With the change to entry age, and I'll explain why we did that, the funded status is now being reported as 107%. So with the state retirement systems, their funding method is the aggregate actuarial cost method. So basically, cost methods take your present value of all future benefits and figure out how do we pay for them year after year? How do we allocate the costs each year? That's what a cost method does. The aggregate cost method always has 100% funded status. That's just how it's designed. It has no unfunded liability. So you can't use it for showing any progression in your plan's funded status because it's just always going to show 100%. That's not very informative. So we choose a different cost method to show your funded status. And in the past, we have used projected unit credit. And there's a very long history in your valuation report using the projected unit credit. Last year, the Governmental Accounting Standards Board, GASB, rules came into effect, and GASB is now requiring for financial reporting the entry age normal cost method. Now, it's just for financial reporting. It's not for funding the plan. But our office felt that let's move to that same cost method in your valuation for reporting your funded status, just to avoid the confusion of there being different funded status numbers out there. Because your CAFR, the Comprehensive Annual Financial Report, is going to show a funded status under entry age, and we now want the valuation to use the same funding method. Does that make sense? It's a long story for why your funded status has dropped, but it's really, it doesn't have an impact on your funding of your plan. So this graph shows you the historical funded status for LEOFF Plan 2. You can see the plan has consistently been above 100%, and again, at the end, 2014, that was the change to the entry age normal. Otherwise, that bar would have been at 113%.
Lisa, is there some way to reflect some of those prior years? Just, for example, say back to 2008 or something, if you could back it up and say what it would have been under the cost method of entry age normal?
I'm not sure how far back we have that calculation. I think it might only be a year or two.
Okay. There's no way to recreate that, I guess? Or?
No, because we don't have that output from our valuation software to be able to calculate that. But I can look and see how far we have it and share that with staff.
I mean, essentially it would kind of mirror the same trajectory. It's just going to be the percentages are different.
It would, and just for a little bit of background, what's happening here is, again, as I mentioned, the cost method is just saying how are we allocating costs every year, and projected unit credit tends to backload it. So it puts more costs in the later years as the plan is maturing versus entry age, which is fairly equal over the years, and that's why you're seeing the drop in funded status, because projected unit credit has lower liabilities in the earlier ages of the earlier maturity of the plan. Does that make sense? Mm-hmm. And so when the liabilities are a bit lower, your funded status is higher. But I will look and see how far back we have that.
Okay, thank you.
So in summary, for the 2014 valuation, the calculated contribution rates are below the current adopted rates, but both rates remain reasonable. Current funded status still exceeds 100%, considered healthy, but that valuation is a snapshot in time, so it's important that we are looking at this every year, even though it's not a rate-setting valuation and the board doesn't have to make any decisions. It's still helpful to see how the plan is progressing every year. The actuarial value of assets now recognizing asset gains, and the change to the cost method that we're using for the funded status. So just to conclude, I'm not sure if you've actually received your report yet, but it is a little thinner than it has been in the past, almost to the point where our office would call this a letter, but it's still your report. And the reason is we're trying to move, we're trying to make this a little bit smaller and easier for you to manage, and move some of the information that doesn't change regularly onto the website. So a lot of assumptions and some of the plan terms and some of the methodology can now be found on our website, and we reference it all in this report. So that's one of the reasons it's smaller. We're also starting to move some things to our website and make them interactive. So I'm hoping this is going to work. One of the ones we just moved this year, so we have 2 reports that are now on our website. If you go to OSA's website, right on the front page of our website, there's a link for interactive reports in the list of many things you can choose, and that's where you can find this. So one of the things we've done is our funded status. Let's see if I can make this larger. So this is an interactive report. Some people are interested in, well, what would the funded status be if we use the market value of assets instead of the actuarial smoothed value of assets? So you can actually choose that here. So if we just take a look, so let's concentrate on left plan 2. Funded ratio right now 107%, as I mentioned. This is the June 30th, 2014 valuation results. And if we switch this to the market value of assets, it's slow, and then you click view report, and then you'll get new results. So that changes it to 115%, which makes sense because we are deferring asset gains right now. So you can do that. You can also change the discount rate. We're providing plus minus 1%, which you've seen before in our valuation. So if, for example, we move to 6.5% for discounting liabilities and still went back to the actuarial value of assets, then work with me, then your funded status would drop to 92%. So that shows you how sensitive your results are to particularly the investment return assumption. So this is now available on our website. We also have one other report available on our website that I'm not sure if I can show you that here right now. And it is, let's see if I close it here. So it's the present value of benefit payments. So in the report, we still have it in this 2014 report, but we show you the projected years and what the expected benefit payments are for your plan for your current members. And then we also do a present value. This next report that just became available on our website, so I'm sorry I can't show you from this presentation, will allow you to change the interest rate and find out how that changes your present value of future benefits. So those are 2 interactive reports we have recently put on our website, and we have 2 more that are in the queue, and that's contribution rates. So how do contribution rates change if you maybe use market value of assets or you have a different discount rate for your liabilities? And then also the age service distributions. These are the tables. I think some people find these very valuable. Near the very back of your report, tables about the age and years retired distribution of law enforcement officers. So this information is now going to become interactive, where you will be able to choose different elements that you're looking for and be able to get a report. So those are some of the things that we are doing over at our office. And that concludes my comments on the valuation report, and be happy to take any questions.
Okay, does anyone have questions? Okay, no questions. We'll move right on.
All right. I'm up again.
Yes.
I am. All right, so this is my good news, bad news presentation. And I'll start with the bad news. Occasionally we make errors, and we did. And so I'm here to share with you updated or revised administrative factors after I presented to you in September the administrative factors for LEOFF Plan 2 and the board adopted them, we then determined that we had overlooked something. And so I am here today to, I'll give you again a little bit, just hit on the background of administrative factors, just to remind everybody what they're about, and then talk about the revisions that we've made and show you some comparisons so you can get a sense for how that impacted factors you've already adopted and provide recommendations and next steps. So again, administrative factors adjust pensions for optional payment forms. So when someone retires, their pension is calculated 2% times service times average final compensation, and that's a benefit payable for their lifetime. There are several options they can choose, and in order to provide those options at no cost to the retirement system, actuarial equivalent factors are applied to that benefit, and that's what these are regarding. And they cover all plan members, and so in some cases, assumptions are made and combinations of factors are calculated in order to have administrative ease and also to cover the whole plan. This is before the board because the board has authority to adopt factors. DRS adopts the factors for all other plans. And as I mentioned, you adopted the factors in September, but then we discovered both some corrections and improvements after they were adopted. And part of that came from doing the factors for all the other plans that we realized, a couple of things. One, that we had made an error in our mortality assumption, and two, some things that we could add to the factors. And I'll go through each of those. So 3 revisions were recommended. One, we had to correct the application of future mortality improvements. So in our software, we had incorrectly coded it, and it was basically double counting mortality improvement for the future. So we needed to get that out. We're already recognizing mortality improvement at a great rate. We don't need to over-exaggerate that. So that was the first thing we discovered. And then we also realized that we are able to use generational mortality improvements instead of estimating an equivalent static year. So what that means is generational mortality improvement means mortality is improving every year at every age. And our valuation uses that. That's what the valuation for LEOFF 2 is using, generational mortality improvements. We didn't think we were able to do that for administrative factors, but we found out we could. So it just makes it even closer to the val, which is what you're trying to accomplish. Before we had to estimate a static year. I know that's very confusing, but and the third revision is we were missing the provision for the death benefit that's available under the annuity purchase factor. So when a member purchases, for example, the airtime, the up to 5 years at retirement, or the new sort of referred to as unlimited annuity that is available under LEOFF 2, when they make that purchase, the amount they contribute for that is actually their death benefit. So if they don't receive enough payments to cover what they paid, they get the balance paid to their beneficiary or their estate. And the administrative factors weren't accounting for that. So that's an important adjustment. Yes.
That would apply to somebody who doesn't pick a survivor option?
That would apply. So
for the annuity piece.
Even if they pick a survivor option, if the total amount of benefits, and DRS can correct me if I'm wrong, the total amount of benefits are still compared to what they paid. So if they pick a survivor benefit and they pass away, the benefit continues to their survivor. The survivor passes away. If the total amount of benefits that haven't been paid, then... Okay. So that had not been included in any of the prior administrative factors we've prepared for DRS, so that was an improvement. So this impacts 4 different factors for LEOFF 2, the early retirement factors, if someone retires before normal retirement, joint and survivor option factors, the annuity factors I just mentioned, and the service credit restoration factors. And I'll talk about each one of those, but there is additional information in the appendix because I went through all this in September. So to save your time, I added some of the information in the appendix. So for early retirement, it's comparing the value of an annuity that starts at normal retirement versus one that starts immediately. So it's reducing the member's benefit to reflect that they're getting more payments. So what I'm showing you in these comparisons are what's called prior, are the administrative factors I brought to you in September that you adopted, and the revised are the new ones. And this is the change from the factors that are currently being used. Does that make sense? So we've got current factors that DRS is using right now. The prior is what I brought to you in September that were incorrect, and the revised. So you can see that for the early retirement factors, the revised factors are just not as big of a change from current, mainly because we don't have twice as much mortality improvement. And then an example. So under the current early retirement factors, if you have a member who has a non-duty disability retirement at age 45 with an accrued benefit of $1,500, the current factors would convert that to $746, the revised $759. So again, not as much of a change as what I brought to you in September. The joint and survivor factors, these factors reduce a member's benefit to recognize the additional cost of providing a benefit that's payable on 2 lives. And if you just kind of look across at the average numbers, you can see that the revised factors that I'm bringing to you today are almost the same on average as the factors that are currently being used. So not nearly as much change as the ones I brought in September. And I believe you've received, Steve, is that correct? They have the full letter with all of the factors. Okay, great. And just to mention, before I go into the example, joint survivor is a little funny because you're adding mortality improvement on both the member and then the joint annuitant, and sometimes you get really funny results, like what I'm showing you right here. And I wanted to use the same example that I brought to you in September, but you're seeing that it actually reduced the benefit in this situation, this combination of age and age difference with their beneficiary. So you kind of have there's a scale. We looked at this to, kind of see, and you have some increases, then some decreases, and it kind of goes all over the board, and it's just that interaction of the member living longer, and then so the beneficiary doesn't start a benefit till a little bit later, and then them living longer. So you do get some funny interactions, but if you go back to this slide and look, you can see that on average, the new revised factors have not changed much from what's currently being used. And this is the only one that you kind of get that really funny interaction. The annuity factor I mentioned earlier, often referred to as the airtime, or now the unlimited within conditions, annuity purchase available for LEOFF 2. So this is strictly a purchase of annuity, and when you have longer mortality, it just will cost more. But the revised factor is a little bit less than what I showed you in September, which is what we would expect. So currently, if an age 55 member is retiring and purchasing an additional $600 of monthly benefit, currently it would cost them $111,900, and under the revised factors, $118,900. So again, not as significant a cost as what I showed in September. And finally, the service credit restoration factors, similar to the annuity factors. Again, it's just a purchase of additional benefit, a little bit less. And this is for members who have left service and taken their benefits, come back to service, don't reinstate that prior service within their, I think, 5-year window to just pay past contributions, but then decide later on, oh, I do want to restore that prior service, then they are required to pay the full actuarial cost. That's what these factors are for. And again, similar result as to the annuity purchase. The cost is more than under current because members are living longer, so it's more expensive to purchase it, but not as expensive as what I brought to you in September. So there you have it. Recommendations, of course, are to adopt these revised administrative factors because they more accurately estimate life expectancies and provide the best actuarial equivalents and are consistent with the assumptions that are used in the valuation to determine funding. And that's a really important thing to understand, is that administrative factors really are being used by the administrator to pay out benefits, and the closest that we can get those to what's used in the valuation for funding, the closer you are to paying the actual costs. So next steps would be for OSA. We have, provided the additional information and tables of revised factors for you. The board would adopt final factors, and then DRS will go through their process of communicating and implementing these, and the new factors would be effective next October.
Hypothetically, then, if a guy was getting older, he might want to retire before October of 2016.
Well, I think, and DRS can jump in if they'd like to, but I think part of DRS's implementation plan is so that they can be communicating the current factors and the impact of those and what is going to be implemented in the next implementation period. So I believe that's part of their plan so that they can be transparent and with members.
Yeah, DRS has been doing this now for a while. They did this with the last implementation of administrative factors as well. The implementation prior to that, one of the things that they learned is you had to pick a particular month to start the new factors. And so somebody who retired a month earlier was getting a benefit slightly different than a month later. Given the difference in the factors, usually it's within, as in this case, most cases, it's going to be within 1% or so. The one area where there might be interest on members, it has to do with the annuity factors. So, for instance, it will now cost more, and the purchase of the annuity is left to members, as we've been reported. That's something that you guys have been doing on average, rolling over your deferred comp accounts. And so that would be something that will be of interest to members to kind of do that comparison. If you're, going to be retiring in the fall anyway, this isn't something where you're going to want to change your retirement date by a year or anything, but say you were going to potentially retire in the fall, then, if you were thinking, well, I'll go out in October, and then you look at it and say, oh, well, actually, I was going to buy the annuity, and it's going to cost me an extra $6,000. Maybe I could go out in September, and all in all, that would even out. But that DRS will be providing that type of information now to members over the course of the next year. And as questions come up to you and as questions come up to us, that'll be something that we'll be educating members on as well. I expect to hear that question a lot, for instance, in the next June at the State Council of Firefighters annual conference. And be a perfect timing where people will be wrestling with that question. And we'll include that stuff in our newsletter. DRS does it in their newsletter, and they do a special communication on this particular issue as well.
Okay, any other questions for Lisa? So we're at a point here where you could adopt these revisions, since we adopted the last ones, and now they've been corrected, we'd have to kind of suspend our general rule and adopt these today, or we could wait until December. It's really up to you. I don't see necessarily any value in waiting, but you could. It would just be a little suspension of our normal course of business.
We have communicated with Department of Retirement Systems, and so had OSA, thank you, and to confirm that even if they were adopted in December, that would still allow DRS to implement them on the same timeline as if they had been adopted as when they were adopted last September. Today versus December, the procedures are we don't put anything on the agenda that you haven't heard before and then expect you to vote on it in that same meeting. So this was not on your agenda for today as an action item. And then that way, if you had questions and you wanted to chew on it or discuss it for whatever reason for another month, you could. If you feel, if you would like to adopt them today, as Kelly mentioned, it would just require a kind of a suspension of your normal operating procedures. But you could move to suspend and adopt today if that was your pleasure.
Okay. Move to second to suspend the rules for your motion. All those in favor signify by saying aye.
Aye.
Those opposed, no. Okay, rules are suspended. Go ahead, brother. Okay, is there a second? Okay, it's been moved and seconded. Is there further discussion? Okay, seeing none, all those in favor, please signify by saying aye. Aye. Those opposed, no. And that motion is adopted. All right, well, thank you, Lisa.
You're welcome.
All right, do you want to move to administrative update and give everybody a bit of a break here and they can...
I serve at your pleasure, Mr. Chair.
Okay, we'll move to the administrative update.
All right. There are a couple of items. First, with respect, there is a quarterly budget update that was provided in your materials. It's the first quarter of the new biennium. All the net result right now is the agency budget. We are about $12,000 under budget through this first quarter. There are a couple of items I wanted to bring your attention to that are a little bit unusual. One had to do with newsletter costs. The billing for the newsletter had some issues, and so we are in the process of getting that number resolved. So the number for the newsletter printing costs may be overstated. The second issue is under salaries. You'll see that there's a credit amount. As all of the board members are aware, one of the staff members right now is going through some medical issues, and she is receiving shared leave from our employees in our agency and other agencies. Those show up on our budget as a credit. And as she uses the shared leave, then it'll all zero out. But at least right now, that shared leave balance is showing up there as a credit amount. The only other item, there was the expense for the annual financial audit was a little bit higher than what we had originally allocated, so we'll adjust that for the future. But again, the total budget is about $12,000 under for this first quarter of this new biennium. And if you have any other questions on a topic or issues that I didn't bring up, please let me know. And you can do that either, you can always call me or email me with questions, at any time. It doesn't have to be today. The second item on the agenda for the admin update is the SCPP update. As I mentioned earlier, with the two policy topics, the SCPP has decided to move forward with both the purchase of annuity by retiree issue and with the disaster response issue. And that does not mean that ultimately they haven't decided yet whether they'll propose legislation on either of those, but they are continuing to work on both of those issues. So for the SCPP, on the retiree annuity purchase, they plan on including active left one, retired left one, and active patrol in their portion, if you will, of the bill. And our bill would be applying to retired left two. Those proposals would get rolled in together. Ultimately, it'll be one bill, potentially endorsed by both boards. Now, on the issue of disaster response, the SCPP is having, as I mentioned earlier, Senate Ways and Means Committee staff work on that. That kind of, now we've got three parties, if you will, in the coordination, so that's going to make it a little bit more complicated. And I don't know exactly how that's going to play out. The SCPP meeting in December is the day before your Left 2 board meeting. So at your December meeting, you will know what action, if any, the select committee took on both of those topics. And we would have bill language for you to consider. Outreach activities, there's been quite a bit over the last 2 months. We have had presentations at the Washington County officials, upcoming presentation at the North Shore Benefits Fair, table at WACOPS and the Fire Commissioners Association. Tim Valencia, as you noticed, is not here today. That is because he is making a presentation to the Washington Association of Sheriffs and Police Chiefs. Here in the last month also, I was asked to present to the National Council on Public Employee Retirement Systems regarding top 10 practices of high-performing public retirement plan boards. And just recently also asked to be an instructor for public trustees for the Trustee Masters Program with the International Foundation of Employee Benefit Plans. I've said it before and I'll say it again. I get a lot of recognition for the decisions that you have made and the good decisions that you have made, and I wanted to pass that on to you. In a couple of other items, in that similar vein of good decisions that you have made, I believe, this is my own personal opinion, that at least particularly maybe in the past, there has been more national recognition or national appreciation of some of the funding policy decisions that the board has made, even more so than in the state. As Teresa mentioned earlier today in her presentation, Washington State has historically ranked in the top 5, still ranks in the top 10 among best funded states. You are among active, open state pension plans. Left Plan 2 has been number 1. So even among the best, your plan has ranked above the rest of the plans in the state. And that's primarily because of the decisions that you have made. All of your assets are invested in the same funds. So the difference between how your ranking has changed over the past, say, 10 years has been because of the actions of the board. One of the things that, along those lines, we were just recently notified that the Public Pension Coordinating Council has given the recognition award for funding for 2015 to the Left Plan 2 Retirement Board. And that is a credit to the hard work and attention that you have focused on plan funding issues. You've made it a key part of your strategic planning from the very beginning. I think it is also an award that some credit goes to the, in my opinion, the excellent actuarial advice that you have received from the Office of the State Actuary. And so with your approval, we intend to provide a copy of this award to the Office of the State Actuary with a letter expressing appreciation for the service that they have provided to you since the beginning of the board. And then you can expect this award also to be prominently displayed in the Left Plan 2 offices. A couple of other issues. Quickly, I mentioned earlier in the interim that the select committee was potentially interested in seeing the legal advice that the board had received from Ice Miller regarding the purchase of the annuity by retirees. However, they made it clear that if they received that advice, then they intended to make it public, which would require a waiver of the privilege on that advice. At that time, the board decided to wait and see if the select committee was even going to work on the issue. At that time, they weren't decided. Now that they have, we are still working with the AG's office to find ways to provide that provide advice to the select committee without waiving the board's privilege. But I wanted to bring that to your attention to see if those methods fail, if we're unable to provide the advice without waiving privilege, if the board would be willing to waive privilege with respect to that advice.
Steve, if I may, I believe they are going to seek the advice on their own, and that should be fine, but they still may come back to the board and ask to not necessarily waive it, but give them the option to waive it in the future should they need to.
This is your last chance to consider it before the SCPP's December meeting. So this is why I bring it to your attention. If they need something different, if they need a waiver, for instance, there's no opportunity to do that prior to the select committee's action at their December meeting. So I wanted to at least bring it up and hear your thoughts on it.
Question?
Mark? Yes.
Can they just pay for it?
That's one of the things, that's what we're talking about, is them getting it under separate advice. It'd be their own. Ice Miller is also the outside tax counsel for the SCPP, and so that's one of the
I'm
possible
sorry.
solutions without waiving
Could they just pay
privilege.
us for it and we'll give it to
Oh,
them?
The issue really is waiving the attorney-client privilege. It's not like who's paid for the advice. And normally, we would assert that there is the same attorney-client privilege. The real difference here is that they want to use it for potential legislation, and therefore they'd have to release it further. We would assert under many circumstances that we have an attorney-client privilege in sharing it with the legislature, but individual members might give it out without asking. And so given this circumstance, we're trying to control and ensure that the board has the right to decide whether or not the attorney-client privilege is waived. If they go out to Ice Miller and ask their own question which would be similar but might be broader or a little bit different, and pay for it, then they have control over that advice. And so I won't advise you here whether you should or shouldn't waive it. We could go into executive session if you want to do that. But that's really the question is because once it's waived, it's just out there, and your attorney, the Ice Miller attorney, could be called to testify, or you just never know at that point what would happen with the advice. So if you want further advice on that, I suggest we do it in an executive session.
Anything further? Well, Steve, I don't see the pressing need for us to take that extraordinary a step in waiving privilege there. So if they need additional information and is that pressing, they can likely get it very easily themselves. It doesn't change what we would do here, other than we might say, okay, now we have to create our own piece of legislation, which we were prepared to do before they agreed to do it anyway. So I think it would be beneficial if the SCPP did it for at least one member of the audience here in their group, but I don't see us taking that extraordinary step in waiving privilege here at this point.
That concludes my administrative update.
Okay. Paul, you ready? We are almost right on time.
I'll just do my best to see that remains the case.
Very good.
Thank you, Mr. Chair, members of the committee. For the record, my name is Paul Neal, and I'm here to do a follow-up presentation on the retiree return to work issue. We've talked about this a few different times, most recently at the October off-site meeting. So I've designed this presentation to fly at a pretty high altitude, but if you need more detail, please feel free to interrupt me and ask some questions. So the issue here that we've been talking about for the last couple of sessions is that the career change legislation that the board proposed in 2005 is sometimes used inappropriately to allow people to continue in what have historically been left positions as left retirees and get both their salary and their pension. The board proposal to close what we've been calling a loophole revealed some tension between that need for public confidence in a well-designed and professionally managed plan, with also the need of smaller jurisdictions to have access to more highly trained and experienced Left Plan 2 members. The issue history, just real briefly, the board first talked about it in 2013 interim proposed return to work legislation that ended up becoming House Bill 2479. That passed the House, did not get a hearing in the Senate, did not pass. Part of the reason that the bill didn't make it through was there was some concern raised by stakeholder groups about this desire to be able to access the skilled pool of retirees to come back and work in what would be lower paid positions for, generally speaking, lower population jurisdictions. During the 2014 interim, the board talked about this again, studied it, devoted to take no action, and then during the 2015 interim, I've been speaking about it again. I provided a presentation to the board in September, and then in October it was discussed at more length. There was a 6-4 vote in the October meeting to update the original bill 2479 for reintroduction in 2016. And just really quickly to go over what that proposal would do, it would provide that let me back up for a minute before I explain these provisions. The current law says that if you're left to retire, you go to work in a PERS position mostly. You have the option to either enter PERS and thus have your left pension suspended, or choose not to enter PERS and continue to receive your left pension. What this proposal would do is say you do not have access to that option with regard to a PERS position if that PERS position was one that would qualify for left, but for the fact that it is less than full-time or less than fully compensated, not fully commissioned, includes some non-left duties, or you're working as an independent contractor. And those are all examples of things that we've talked about in front of the board of ways that positions have been adjusted to get around the current limitations. So that's what came out in 2479. That was what the board voted 6-4 to present again. So a copy of the draft legislation is attached. I don't believe we're asking for a vote today, but just want to provide that for some more information. One issue that has come up just in the last couple days, is if someone were in if a left to retiree were in a position that was a legitimate, historically, let me say, historically part-time police or firefighter position, which would not qualify you for LEOFF ordinarily, if this bill in its current form passed, then that person would see their pension taken away or suspended for that point. The issue this came up is there have been some discussion in front of the Select Committee on Pension Policy lately about volunteer firefighters and I think reserve officers also who are in partly paid positions and maybe actually making a salary as opposed to just a stipend they'd be getting if they were strictly volunteers. And in some cases, those positions, it's possible they could, if they had enough hours, they would end up becoming PERS positions, which would then bring them within the scope of this bill. What we're understanding and from talking to folks out in the field is that the volunteer firefighter, or the fire districts, I should say, watch this pretty carefully to make sure people don't, they're very aware of where that line is and watch it so that people don't go over that line. But just, I don't know if it's further clarification or further muddying of the waters, but if there was someone who was in a historically part-time police or firefighter position and that person were a retiree, this would change their ability to work in that position, draw a salary, and have their pension at the same time. I hope that clarified and did not just further confuse, but I'm happy to take any questions on that issue or any others. Seeing none, the next steps are options, which is to direct staff to present a final proposal. As I mentioned, we do have a draft bill language attached to your materials. If you want us to move forward, we would try to see if we could get a fiscal note before the December meeting. The fiscal note for the proposal in 2014 was that it was an indeterminate cost. And the other option, of course, is to take no further action. So I'd be happy to take any questions.
Any questions? Michael?
Not a question, just would like to move option 1.
Okay. Is there a second?
Second.
Been moved and seconded. Discussion. Remind me again, Paul, why was there even a question about fiscal note on this one? Where would the cost be associated?
I don't believe, I think it would be indeterminate just because they wouldn't know how many people would do this, but I think if anything, it'd probably be a savings because you'd have people whose pensions were not being cut. So it'd be I guess you call it a negative fiscal note?
OSA does a fiscal note on all pension bills. So that's the genesis of the request for the fiscal note. And then it's also part of the board policies that we work with OSA to get a fiscal analysis on all final proposals.
Okay. So indeterminate meant too difficult to figure out, or I mean, not able to figure it out, or
Typically, indeterminate means that they don't have enough data available to assess what the impact is, as opposed to not enough to affect contribution rates, where they know the cost, it's just not enough to affect rates.
Okay.
In this case, trying to figure out how many members would have their pension suspended, there's probably not sufficient data on that.
Okay. All right, it's been moved and seconded for option number 1 to direct staff to present a final proposal. All those in favor of that motion, please signify by saying aye. Aye. Those opposed, no. Okay, that motion carries. All right, Paul, you're still up.
Okay, thank you.
You got us back on track.
My best.
Outstanding.
Thank you, Mr. Chairman, members of the committee. Again, for the record, my name is Paul Neal, committee staff, to do a follow-up report on the retiree annuity purchase issue. Again, this is an issue where we've had some presentations leading up to this meeting, and this is a follow-up. The issue is that current state law does not allow retirees to roll over their tax-deferred savings into LEOFF Plan 2 to purchase an annuity. And if you remember, 2014, the board requested the legislature adopt legislation, which it ultimately did, allowing people at the time of retirement to take that option to purchase an annuity. And at that time, retirees really weren't on the table. The issue was raised later. We had to go back and determine that, in fact, it would be consistent with federal tax law to offer that option to retirees. Doing that would require legislation. The originally LEOFF Plan 1 retirees and State Patrol retirees asked to be included in the board's legislation. The Select Committee on Pension Policy has since determined that they want to retain jurisdiction over those groups, and they're going to be working on that. That if the Select Committee has a bill and the board has a bill, that raises the potential of possibly an amendment during session to combine those bills. That's more a question of legislative convenience than anything else. Just as right there yet. Just as quickly as to why we're doing this and why the board thought this was a good idea based on the information, just because, again, I'm doing this as a follow-up. Before the board did anything in 2014, it was possible for people to buy annuities in the private market. It was also possible to purchase service credit, which has much the same effect. The additional benefit that this gave, and why this was consistent with the board's strategic goal to improve benefits, which we're learning does not necessarily mean increasing cost, is that it allows the members to purchase the annuity through the LEOFF 2 trust fund rather than on the private market, which the main difference is the interest rate charge in the calculation. And just the information we did for a person retiring at age 56 with $100,000, they ended up getting $175 a month more for life just because they purchased the annuity from LEOFF 2 rather than purchasing it in the private market. So there's that benefit. The other plus was that the existing law, which was the service credit purchase, is limited to 5 years of service credit purchase. And some members had indicated that they would like to purchase more, so this allows them to do that. So that was sort of the advantage of doing this, and it is also kind of points out why retirees are interested in having that opportunity as well. The options at this point, much like the last one, are to direct staff to present a final proposal at the December meeting, which would include a fiscal note, hopefully, or take no further action. Take any questions?
Questions for Paul? Okay, seeing none, entertain a motion. Mark?
I move to select option number 1. Move it forward.
It's been moved and seconded. Is there further discussion? All right, seeing and hearing none, all those in favor, please signify by saying aye.
Aye.
Those opposed, no. That motion is adopted. Thank you, Paul. All right, next item on our agenda is to try to see what we can do about adopting a 2016 calendar of meetings. And we've got, try to put as much information together as we can, which includes weekly or monthly meetings of different elected officials here, as well as the meetings of the associations that are also represented here, and to include the staff here and the availability of this room. So all those things coming together, we are trying to adopt a calendar for next year.
There's a draft calendar in your materials, and as you will notice, the draft calendar is consistent with the board's longstanding practice of having meetings on the fourth Wednesday of every month. That includes meetings are scheduled during session, and the only exceptions to that are when, as Kelly mentioned, there was a conflict with a particular event, like the State Council of Firefighters Annual Conference or WACOP's Annual Conference, where we knew then a majority of the board members or a good chunk of the board members would not be available. So we've scheduled around those conferences. We've also scheduled around certain like NC-PERS or International Foundation training opportunities that are available. Next year, for the most part, though, it worked out that the fourth Wednesday was available every month except for October. That was the only time that we had to actually change from the standard fourth Wednesday. That does mean that the December meeting, whereas this year it's, I think, December 18th, had to be moved up before Christmas. Next year it would be shortly after Christmas. I don't know that that's a concern. Also, as mentioned in previous meetings, the fourth Wednesday happens to conflict for council member Up the Grove with a monthly obligation that he has for the council. Now, I will say that in trying to balance the availability of the boardroom around the times that the State Investment Board needs it, the conferences that we're aware of, and there may not be any dates where all 11 board members are going to be available. And even if in November of 2015 we think a date's going to work, that doesn't necessarily mean that by 6 months from now that a conflict will not have arisen. The plan for next session or for next year is that meetings during session will still do some kind of electronic updates as opposed to full board meetings like we did earlier this year during session. It's a short session year, so if they end on time, that may mean that your first meeting of the year would actually be April 27th. To the extent, it's on there as for possible board action today, but to the extent that you would like time to allow for all or more board members to be present to participate in this, then if you wanted to defer action on adopting the dates until December, that would be fine. In the past, we've tried to do it a little bit earlier in the year to make sure that we didn't get bumped by other organizations that were trying to schedule the SIB boardroom. However, the SIB now, we're the only organization that they allow to share their boardroom, and they've already got their dates for next year booked. So that need to sort of act early has been reduced. If you have any questions, though, about any of these proposed dates, or if there is a conflict with something that we weren't aware of, please let us know.
All right, you want me to lead this circus here?
Yes.
Okay, all right. All right, so the first question, I guess, is do we want to have a recurring day of the month, or, like fourth Wednesday? Do we want to move it to a third Wednesday or a third Thursday or fourth Thursday? I know, I believe SIB here is the third Thursday of every month, right? Is that right? Yeah. And then that varies a little bit when we get down towards the end of the year with holidays. So the one conflict I know that we have, we mentioned Councilman Up the Grove has has a date conflict there, and I don't know if there used to be, we mentioned this in our administrative committee meeting, Senator Parlett used to have the JLARC meeting was a conflict, and so trying to accommodate all of those things. If we can pick a given date of the month, it would work, or a day of the month, I guess I should say, would be best, and then we could work around that as we run into the conflicts and try to move it, a day or two or a week or two, forward or backward. So looking at our calendar here, so January, February, and March, I don't think we have probably a real need to do much different, do we?
I wouldn't expect so.
Getting that we're going to be probably doing electronic or...
Right.
And session is through a short session, so April would be our first. And Steve, have we asked board members to provide that information and we just haven't got a good response yet, or picking a day of the month?
We haven't asked for that specific question, like would the third Thursday work better than the third Wednesday? We have asked board members to provide dates that they were available. One of the things that we, not for all of 2016, many of you don't know your calendars for all of 2016 yet. Some of the legislators and the city officials know some standing meetings that they have. One of the things, though, that we found is with 11 of you, there are no dates where a standing date, for instance, where everybody's going to be available and the boardroom's going to be available, and it doesn't conflict with any of the other obligations that you have to your associations, for instance, the Fire Commissioners Conference or the Association of Washington Cities events. We factored all of those into this calendar. We haven't gone back and done like a hardcore analysis to try to figure out what would be where could we get the most members on a particular day each month for next year. But I will say there is no date that's sort of the magic bullet date, if you will.
So what if I just throw out third Wednesday? Does that work on the on this venue?
The third Wednesday creates conflicts for the State Investment Board in several months. May, June, September, November, and December. Or May, not December, just May, June, and September. And November. So there's 4 months where, looks like April as well, where that would not work.
Anybody here have, I think the people that are not here are the ones that have more conflicts than we do.
That's why I was wondering if it might be better to have the discussion in December when you might have more board members attending. My understanding is that other than Councilmember Up the Grove, right now, I believe we know everybody will be able to be there in December. And Councilmember Up the Grove might be able to be there in December as well because the date was moved up to the 18th.
Okay, can I suggest that we put an email out to each one of them and tell them to provide information as to, day of the month that would work best for them, and that we will be discussing this in the December meeting to pick the calendar? Okay. All right. Not nearly as painful as it could have been. Paul?
Steve, could I ask you about the third Thursday of each month? Does that conflict with anything?
The third Thursday does create some conflicts with the SIB as well. There's five months where they've already got that booked.
Is there a way to do, I know we could do this with Google, you can throw these items on there on a calendar that say, here are dates that we already know would not work. Doodle then? Okay, doodle.
We'll try to come up with something like that for the December meeting.
Okay. When you say we, it probably doesn't include you as much, right, on this technological, yeah, okay.
Yeah, you're probably talking about Jesse on this one. It's kind of the royal we. I'll have to approve it.
Oh, okay, good for you, Steve. I understand that concept. All right, agenda items for future meetings. Do we have some of those here, Steve, that we know of?
Right now, what you have scheduled for December is the final proposals on the 3 items that you voted on today. The emergency response item, the retiree return to work, and the retiree annuity purchase. You will also then be adopting calendars for December, and you have no other actions or items currently scheduled.
Okay. Anything else? Any additions to that or anything that we know of? Okay. Go to the order. Anything for the group? If not, we will be adjourned. All right. Thank you, everybody. Travel safe. Have a good Thanksgiving.